Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour. Futures market closes at 5 p.m. Eastern. If you're joining us on the platform, if you're on tastylive.com, welcome. Thanks for joining us. Come over to YouTube. Tell us what you're trading, what you think of this late day market sell-off. Ilya, you and I had a chance to speak midday today on Futures Power Hour, and things got worse for the wear as the day went on. A bad 20-year auction, weak bid-to-cover ratio. We see it tail through. Just where's the foreign demand? Ultimately, it goes, and so too do the yields. 10s through 4.5%, 30s clearing 5% with ease. Stocks, it's all just too much. S&P 500 off 1.74% right now. NASDAQ off 1.48%. Your Russell is your leader and loser to the downside, off by 2.86%. Bonds just take an absolute beatdown as we turn to the charts. We see a move below 111 in ZB. It's just no good. Gold, silver enjoy it, though. Maybe it's all because of the fiscal situation unfolding. Downgrade or news out of D.C. Likewise, the dollar getting sold off. It's a sell America kind of day overall. Dollar down, stocks down, bonds down, gold is up. Ilya, you and I had a chance to speak midday, so I want to kick it to Dylan first here. Dylan, when we take a look at our charts, we look at our stocks, this is not the bullishness that you and I have expected. Are the politics of it all just becoming too much for the stock market and the bond market?
I mean, the thought that I had when I saw, obviously, the events of this afternoon was that the dismissal of the ratings agency, I think this ties to the ratings agency downgrade. Not that the ratings agency downgrade created the bond auction or the bond auction result. Rather, that the bond auction result is a validation of the downgrade, and that the bond auction result is an indictment of the Trump administration's economic policy, which obviously the downgrade was also an indictment of the Trump administration's economic policy. But because the ratings agencies have basically no credibility, no one really pays much attention to them, but the bond market has perhaps the most credibility. So when the bond market won't play, that really becomes a validation of otherwise ephemeral concerns. And I do think that is consequential in the sense that the only corrective measure that's available to American financial policy is the bond market. And this would be a clear indictment of exactly that. But Mike, what I was saying to Tom earlier was, it doesn't give me huge concern, honestly, because I think it's the power of the correction is meaningful, and I think that I still think it's a buy the dip, honestly, in this case, because I think the bond market is slapping the Trump administration on the wrist in a way that I think will have will have an influence to the benefit of the financial markets.
I mean, Ilya, that's the question now, because we did break down through the Liberation Day or post-Liberation Day lows here, and those were the levels that the administration, Trump himself, said that traders are getting kind of yippy. So we're through the yippy levels now. We haven't cleared the yearly low in ZB. Does this invalidate the perspective, as we've been toying with here, that the Trump put in ZB and ZN and TLT is dead?
I mean, maybe. Is the president back in Washington yet from his sojourn in the Middle East?
Yeah, he's been on Capitol Hill whipping votes for his tax bill.
Well, there you go. So I don't think you can necessarily say that it's the level that matters here. Obviously, the last time we were at these levels, the speed with which we got there was shocking. This time we sort of coasted there more slowly. So maybe we just don't have the attention yet from the White House to basically say this is what's going on. Maybe there's an expectation that once you get this bill through, this unclenches, although I'm not sure how that works out. I think a lot of what's going on here may be related to the fact that this bill is going to blow out the deficit by another, let's call it $4 to $6 trillion, depending on how you count it. So there is some of that here. In my mind, what we're starting to see, because this is not a rise just in the U.S., we've seen rumbles of this really since the beginning of the week, and it really has put the past several weeks of data into context. We're seeing inflation come back. We saw it out of the Eurozone data at the start of the week. Then we saw it out of Canada's data. Now overnight, we've seen it out of UK data. And in every single instance, what we've seen the markets do is respond by saying, oh, this will restrain central bank rate cuts. Now, you put that in the context of growth data that showed us in April that the world economy is expanding at the slowest rate in 17 months. That's about to get updated within the next 24 hours. It's probably not going to look any better, judging by the leading indicators. And so you're getting into stagflation territory. Not stagflation actually, but stagflation as a thing for people to ponder. Obviously, Fed Chair Powell has pondered it out loud. It's not exactly a taboo subject. Jamie Dimon has obviously pondered it out loud this week. And he may be talking his book, whatever, but that doesn't mean he's wrong. So when you look at all of this, it starts to feel like, okay, so weak growth, high inflation, central banks can't do anything. What happens? Yields go up. So you get into this thing where if central banks aren't going to push back on this growth slowdown, if they're not going to be the usual kind of counter-cyclical force because inflation isn't letting them, well, then the bond market will do the work itself. It'll demand higher yields, especially down curve. That's how you get a weak auction. It's how you get yields higher everywhere, including, of course, Japan, where there's an utter meltdown.
Yeah, I suppose that's the next question here, because it's not I mean, the U.S. is seeing yields move up a little bit faster than everyone else, but this is also not just a U.S. phenomenon right now.
Mm-hmm.
You're seeing yields push up globally. Japan obviously is a place of interest. Dylan, this is not a narrative that's being discussed right now, but our friend, the third leg of this stool, suggested it in passing today on Futures Power Hour, and it got the wheel spinning in my head. What if this is another repatriation episode out of Japan, right? Japanese yields are spiking. The Nikkei is coming in pretty hard. The yen's holding up throughout all this, which, shows that it's not necessarily a Japan-specific issue. But then again, that would be capital inflow to Japan. The currency is getting bid up, even as the U.S. dollar is seeing interest rate differentials move favorably. Should we be thinking about this market in late July, August 2024 redux terms? Is that even something on the radar right now, or is that just too far afield to consider?
Yeah, I mean, I don't know. I think Ilya kind of has a handle on it in the sense of, inflation and sort of economic, the boogeyman of the worst of all worlds, man, is which I don't actually think is here, but is there are whispers of it in the bond auction that open the door to 1,000 versions of catastrophic thinking and catastrophic comparisons. I don't see the comparison necessarily to 2024. I mean, I guess in the stagflation-ish sort of, in the sort of, we still have slowing growth and risk of inflation. Is the sort of never-ending threat, I guess. I still look at this like I think it's a buying opportunity at this point. Just because I think I think that the Trump administration is subordinate to the bond market, and that this will incentivize, a policy review. Like this is if you're Scott Bessent and you're the Treasury Secretary and you see this, to the degree to which you were complacent or compliant, I guess, with the Navarro-Lutnick agenda, I mean, I would just walk this chart into the room, and there are a bunch of other charts that are friends of this chart, and say, you can keep it up, but this is what's going to happen. Maybe they don't care, but maybe they don't care about the financial markets, but I think ultimately they care about their political capital.
Refinancing the debt at higher rates, it's a simple function of supply and demand right now, right? If we're going to be changing our debt trajectory where deficits will be higher than they were last year, the current fiscal year, the prior fiscal year, the fiscal year before that, really just it's increasing the pace of spending. The market is levying a vote right now, even with the lack of demand at today's auctions. The world is saying, if this is the way that you guys want to spend your money, we're going to require a little bit more to finance that kind of taxing and spending. 110 and 25 ticks is not that far away from the yearly low. Yearly low in ZB comes in at 110 and 13 ticks. Ilya, you were with me on Futures Power Hour today. I saw that auction result. I threw in the towel. Directionally neutral, long delta, anything in bonds. And I say bonds specifically because it's not notes. But ZB, for me, I'm out. This has been a loser. I've been repeatedly kicked in the teeth for the past few weeks. It was good at times when we got those bounces off of the 112 area. Something feels different, and the trajectory, and here's what concerns me, right? The trajectory for the bond market to be the mechanism of discipline right now, we're going to have to see what this House vote does. Okay, let's just entertain the idea that this is related to, it's not the downgrade, Elliot. Don't worry. I'm not going down that path. But let's say it's related to the U.S.'s current trajectory for spending. Mm-hmm. An echo of what Moody's and these other rating agencies have said. Let's entertain the fact that that's something that is the backdrop here. And we're plowing ahead despite independent observers telling us that we're spending too much money. We're doing it in an irresponsible manner. The train probably doesn't stop until this bill gets to the Senate. Right? The hemming and hawing, we did have an agreement with the SALT caucus. So they're out of the way right now. It looks like this could go to the floor. The Senate is going to not vote this in. They're already talking about a completely different package, which is also one of the reasons why I think this is probably overblown. Mm-hmm. But at 30 days to expiration and looking at the political calendar before the Senate passes their own version of the bill and it gets sent back to the House, I don't think this is the right timing for directionally neutral for looking to be long deltas right now. So I cleared my ZB book. I think there's probably going to be more pain ahead, and then we're going to get a nice bounce. Because the reality ultimately is that the economy is heading in a direction that's going to bring down growth if we continue along this current path. And if you look at the specifics of this bill, it is, I'm going to be clever here quickly. There's Robinhood, which is taking from the rich and giving to the poor. This is Hood Robin. This is an upward transfer of wealth. Even with the SALT, whose benefits from the SALT deduction changes? The wealthiest, right? More money in their pocket. They get to deduct more in places like New York, California, Illinois. So I'm just not comfortable being long deltas in bonds right now. I know that you have a little bit of a different feel. You're a little bit more comfortable. That could just be a function of positioning, sizing, time horizon. But my time horizon with 30 days to expiration, I'm not holding on to this anymore. I'm wrong. It's lost money. Move on.
For me, I don't see a reason to get off, only because, and we talked about this a little bit in Futures Power Hour, we're at the low. So the risk reward, if you were to put on a new short right now, is terrible. So looking at a trade in isolation saying, would I sell some bonds right now? No. Now, if it broke this low, maybe, yeah. But it's right at support. And so the risk reward to selling them is terrible. So why would this be the place for me to get out of my long positions? Doing so would be to sell the bond right here at terrible risk reward. So obviously the trade is underwater. It's not underwater by a lot, and as ever, I'm using long duration risk defined verticals, so it has a loss of less than 1% locked in to it. And so, okay, fine. Let's see. If it breaks this thing, I may just flip the whole thing over and end up short. But for now, I'm willing to let this ride out and see. That isn't because I'm terribly constructive. This is awful price action. It's not because I believe fervently that the bond is going to rally from here. It's just math, risk reward math.
I hope you're right. If this is a freak out because of the House bill, this is not the bill that's going to be signed into law. The Senate has already said there's a number of things that have been put into the House bill that the votes aren't there. Right. So again, overreaction short term. Yes. My positioning offsides, didn't like my position sizing, but you can see the effect of rates spilling over into the equity market today, Mr. Radigan. Outside of GDX and GDXJ, the other 23 ETFs that we track here, of those 25 are all underwater, and a lot of it are the rate sensitive names. You could see that KRE, the regional bank ETF here, that's down 3.56% today. It's firmly rejecting the downtrend off of the November 24, February 25, and now May 25 trend line. We very well could also be losing the uptrend from the June and March swing lows once more. It's a pretty ugly looking chart. We're back below the 1 month moving average. It's also some of the tariff names. XRT is down over 3% today. XRT, which likewise try to get back to the levels we were at prior to February 21st when we had that bad PMI report. Now failed there too. Dylan, is this the realization of everything Jamie Dimon said? I brought this up to you yesterday. Markets were too complacent. The bond market, it woke everyone up in today's session.
I mean, it's very, I don't think so. I think this is a little slap on the wrist. I would need to see more than one afternoon of anxiety about the U.S. bond market before I felt like there was any real validation outside of, thank God the bond market exists to correct some of the misguided actions of the U.S. government. But I think that I think that it is corrective, and I would need to see this last longer. Basically, I'm using a stealing an Ilya line. Until this continues, I consider it an aberration.
And by the way, it certainly could be. I just don't think it's anything necessarily to do with the spending bill or this or that. I think those are all nice kind of adjacent talking points. But if this really is about, oh no, central banks can't cut, but growth is turning lower, and this is what's getting built into yields across the board, it's not going to be even in its application across markets. And to the extent, Chris, you're right that this is not going to be the bill that goes through the House. The markets might get kind of dribs and drabs of, well, if it was about that and that's resolved, then this is resolved. And so you get back and forth in markets as they kind of figure out, is it fixed? Is it not fixed? Was it about that? Was it not about that? So it'll be back and forth. But I think there's a larger issue here, a stagflation issue, not in terms of being here. It isn't here. That's obvious. But in terms of markets being worried that it's coming. And that speculative interest is enough. So my sense is that there's something larger under the surface here, and it's happening everywhere at the same time. And to the extent that the markets later jump on, oh, this is fixed and that's not the spending bill, and we had a better auction, and blah, we're going to get those things. And people will unclench because it's not about the downgrade, and it's not about one bill, and it's not about this or that. But the risk is they will misread that as a fixing of the issue, and the issue isn't that. It's bigger and broader.
Bigger, it's broader. Dylan, throughout all this, there was a brief moment today where we saw crypto prices spike again. BTC, that is a touch of a new all-time high. Very quiet this time around. Just from your sense, it feels like there's a different attitude in the crypto world. Post-election to January, it was a parade. It was all, balloons. It was a party. Feels like no one is out in the street celebrating this time around. Is that ultimately a good thing? Because the sentiment hasn't swelled?
I mean, that's I think it is a good thing, and it goes to my assertion that crypto is moving into more and more. I don't know about crypto. Bitcoin is moving more and more into a higher integrity, or a higher integrity, and ultimately, I think, lower volatility asset, which I think is honestly preposterous and a sign of the end of the world, but I do believe that it is what's happening.
Ilya, give us something positive about crypto. It's sitting.
I think Dylan is right. First and foremost, I think the introduction of ETFs in particular was a really big step in mainstreaming this stuff and getting volatility down and getting participation up. But I have no problem with crypto as that. I have no problem with crypto as another asset that people can buy and sell and make a market in. My problem with crypto is when the conversation goes to this will be the new currency, this will displace government-issued currency, this will be the new dominant ex-government way that payments are done globally. And the answer is just no, it won't. That's not going to happen. But as a tradable asset, sure, enjoy.
I'm having trouble finding it right now. He tweeted it earlier, but he has his tweets set to auto-delete, which, okay. Anyway, Mike Dudas, maybe someone remembers this. He's a crypto investor with Six Man Ventures. He co-founded The Block and Linksdow, the golf course. He pointed out what happened in terms of flows in crypto from the start of the year until now. And basically during the time period when Bitcoin was declining, January onwards, individual wallet holders were shedding Bitcoin and institution was accumulating. And institution has been accumulating while retail has basically been flat net over the past month. So we talk about institutional adoption. It feels like that also covers the world of ETFs. So if someone has their own individual Bitcoin and they decide, I don't want self-custody anymore, I'm going to sell out and I'm just going to buy IBIT moving forward instead. I suppose you would see the deduction in the individual wallet holding and the boost in the institutional, but even accounting for that, it's still more institutional inflow over the same time horizon if you wanted to net it out. And I think that's part of the reason why it's quieter this time around. It's that people weren't really leveraging up in April. They were nursing their wounds. And so there's a lot of chase going on in the market right now. Again, no cheerleading, right? There's no champagne being popped, Dylan, like there was back in January. I wouldn't be surprised if this thing runs for another 30 or 40K before, people start gloating again, quite frankly. We should be prepared for that.
What do you mean by that? What do you mean before people start gloating again?
Before you have,
it could quietly go higher before it becomes sort of effervescent with its enthusiasm. Is that what you're getting at?
Yeah. Well, Ilya, you recall back in mid-April, I was saying that it looks like Bitcoin may be breaking out and it's quiet and no one's talking about it, right? Mm-hmm. We highlighted an IBIT trade if you were recall a few weeks ago, for those that took it, looking at a return, what a call spread would look like playing for a return to all-time highs now that we had cleared back above the former support at the end of April, just as what do you do in a consolidation? You return into it, you move to the other side. Okay. But again, not being celebrated this time around. So it feels like people now, we just set a new all-time high. Oh gosh, I haven't participated. I need to get in. You got to run here. But who's talking about this for the last 20 or 30K? I haven't heard a peep from the usual suspects.
No, not really. Not really.
Where are the TikTok?
You're right.
Where are the videos of Dave Portnoy talking about Bitcoin?
I haven't seen them. To your point, it is possible, certainly, that there is chase here, and I think you don't have to go very far to consider that this thing is priced in terms of dollars, and the dollar is selling off. So you have an inherent sort of tailwind here, just in terms of arithmetic. It's interesting the extent to which this might become a reflection of risk sentiment again. I don't think we've really crossed any red lines on ES and Q. We have on the Russell today, we talked about that range break on the Russell on Futures Power Hour, saying if it breaks with a 4-hour close, I'm short. It broke, I'm short. So if we get a bigger risk-off thing developing here, it'll be very interesting to see if these levels on Bitcoin hold or if it becomes a risk-on asset in a risk-off market once again.
Ilya,
kind of to see the Aussie give up its gains, which isn't encouraging for this.
If it's a stagflationary environment in a world where we hold the belief true that Bitcoin is a safe haven.
Who holds that belief true?
It's just, I know you don't, but I know that there are people out there who do. Right?
He says.
You are a human, and amongst the human population, there are people who hold that belief true. So collectively, you are part of that. The technical here, take a walk with me. Swing low in August, high that you have in January, lows that you have right around the second week of April. That gives you a 100% Fibonacci extension at 135,300.
Completely a plausible thing. I mean, let's put aside the fact that I'm sort of constitutionally skeptical of this entire sector, and I'm not participating one way or another. In terms of the structure and the logic, I'm not going to argue with that. I'm not saying that I agree with it per se, because again, for me, just from an analytical perspective, I want to see how the winds of risk aversion land here ultimately. But does this make sense as an idea? Absolutely.
Dylan, let's talk more action. This feels like a fait accompli, only because it's a great expiration. Hopefully I don't expire on July 18th, because that means it's a clean 36 years, and then that's the end of the clock. So let's do the birthday expiration here, Dylan. On this Fibonacci extension is something like IBIT, which is a little bit more liquid than the Bitcoin futures here. That would give you an equivalent target of about 76. So playing for a long out-of-the-money call spread here with 58 days to expiration. You talk about doing something that's in the madman territory, long the 70, short the 80. This is a pretty decent trade. It's about a 5-to-1 right now, 22% probability of profit. I think that's a decent way to lever up if we're heading into a debt limit, debt ceiling debate, tax bill, fiscal nonsense cycle. I know it's been very quiet, and people may have their long-term holdings of Bitcoin, but as a trade, this looks like a prototypical flag right now that's getting ready to break out following a long period of congestion. Could I entice you into a madman trade that's long out of the money call options on the Bitcoin ETF?
Absolutely.
So I'm going to put this up in the tastylive follow account tomorrow. But again, IBIT here. Ilya, this is, forget the ticker for a second, my friend. If this was in, I have this over here for this bet. If this was in this textbook, okay, it finished, and we saw a breakout pull back to former resistance turn support and then a move up through the new swing highs. That is a textbook flag type event. I mean, that is a buy.
That's a buy,
right?
That's
a
it.
buy. Okay.
I mean, it's a trend that's stair stepping.
Check the book.
I mean, listen. First, page 1. This is how support and resistance works. Oh, look, a break of resistance, a pullback to former support, and next leg higher.
And the next leg higher begins.
This is the classics.
It fits with what's happening in gold, I suppose to say, which our hesitation last week has been vindicated with holding on to what has been a very good trade over the past year plus for me, for you, Ilya. Dylan, I know that this isn't your cup of tea, so we're going to go to gold and talk in silver terms quickly, which is up another 1.53% today and starting to break out. But Ilya, gold up, Bitcoin up, dollar down, stocks down, bonds down. Maybe it's not sell America like it was in the first week or two of April, but it certainly has that stench.
It really does.
What's the catalyst to stop this over the next 2 days? Or do we really need those PMIs?
I mean, let's kind of take a step back to what we were just saying, right? There's I think the big story, which will take some time to unfurl and for the data to start to show it, and the PMIs are a big piece of that. And that's are we going into stagflation risk territory? Which, by the way, if globalization reduces the cost of doing stuff just across the board because it reduces commercial friction along the supply chain, then deglobalization increases costs for exactly the same reasons. We just went through 40, 50 years of deepening globalization that came with structural disinflation and a structural decline in rates. We've obviously turned a corner. We've heard the Fed talking for a few years now about a higher neutral rate because inflation is going to be higher. Deglobalization is very much a part of this long-term mix. So are demographics. We're watching deglobalization happen at very accelerated speed since the beginning of this year. Is it any wonder that that is becoming a tailwind for inflation? Of course it is. That's exactly what you would expect. That's exactly what should be occurring by any stretch of the imagination. And it's now showing up in data around the world. That is being taken alongside the negative growth effects to mean that you're going to have a situation where central banks can't act, but need to because growth isn't good. So growth is allowed to get weaker. Rate cuts move out downwind for when there's a real emergency. That's the larger thing. The episodic thing is the bill in Washington, the situation in Japan where they're deciding how quickly they want to unwind their balance sheet, and that's why you're getting all this fuzz in those markets. The BOJ thought it would be a good idea to go ask market participants how fast they should go, and they got the results back. So they sort of made a news cycle out of it. And now there's a cliffhanger in June for the BOJ when they're going to actually make the call. So you get a lot of kind of episodic stories around the theme where it's tempting to assign what's going on to those things. And when those things are resolved, as they invariably will be, if only because the markets benchmark them, price them in, and move on, it'll be tempting to say the problem is fixed. And markets will probably show that. So you probably get a little bit of an unclenching in gold. It comes down a little bit. Bitcoin, maybe. Dollar anchors a little bit better. But will that mean anything is fixed? No. And so you could see some near-term back and forth here, is what I'm saying. The president is out there goading policymakers to pass this thing. Over the next several days, they'll pass something. Or they'll get close to passing something.
Something will get advanced to the Senate so they can just move on for a little while, but the Senate's going to send something back completely. If you're watching John Thune or any of these Republicans who are, who just got elected, they are like, well, I'm not going to just throw the Medicaid and Social Security folks under the bus.
And they will pass a spending bill of some kind, right?
Something's going to get done.
It'll come back. Well,
they can always do a continuing resolution.
Right. They'll argue about it some more, right? But it's not like this won't get resolved. It will eventually. The real question is, does the issue that we're watching now then get resolved? And my suspicion is the answer is no. So
the issue
you're going to get some back and forth here, but I think the direction that we're seeing is right.
The issue being rising deficits and debts, right? Which that to me is one of the
stagflation.
Great for gold, though. Which I would point out in the bottom pane here, IVR has been creeping up the past week or so. It bottoms here on May 13th. IVR hits a low of 40.9. It's now at 57.4, and during that same time horizon, gold has moved from about 32.40 up to 33.17. There was a little bit of a dip in there along the way, but rising vol with gold prices moving up. It's been one of the consistent things that has worked out over the past year and a half plus. Contemporaneous indicator if gold is going to be breaking out to the upside, as it does when it returns back into the channel, when it moves back above 32.65 or so. That's a sign that you want to see if you're going to be leaning long. Like I'm looking for a return to all-time highs. I'm leaning on my long call spreads in the tastylive account here. To continue along the current path because nothing really has changed, right? Deflation.
I agree.
Deflation would be an issue for gold, but that's not where we are. So, Dylan, to loop you in now, we're up 1.5% today in silver. It's finally breaking out again, and silver volatility is popping up down here. Are we ready to get back in and, as you might say, corner the market?
Can
I tempt you, Mr. Hunt?
I think that for all the reasons that Ilya is referencing and you're referencing, especially with the expanded volatility, I think a put spread is a reasonable thing to do in silver.
Ilya, silver volatility really expanded over the course of the day today as this thing ran up. It was up around 1.3% or so when you and I met for Futures Power Hour, but IVRs were sitting right around 20. Yeah. And so it's now up 1.5%. It's challenging the highs that we saw from late April, and it's now at 37.8 IVR. For one, I'm looking to roll my call exposure that I have. It's going to expire worthless, right? So I'm just looking to reestablish my position here because buying silver calls over the past year again plus has worked out. So sometimes it doesn't work. This time it didn't. Thanks to early April, I don't see any reason not to press on. I know it's more growth sensitive than gold, but 35, 36 looks awfully juicy given the volatility environment where it's only just starting to rise.
For me, if you don't have exposure already, right, you're mentioning your rolling exposure that you want to extend. I don't have any silver exposure. I only have gold exposure. So from the perspective of somebody who does not have any stake or any skin in this particular market right now, I look at the swing high from April and go, you're at resistance. Break it. And then let's go. But from a risk reward perspective, I don't think you have a reason to allocate an incremental dollar here today. I think this should be very high on your watch list because all of the reasons that we're talking about here for this to go higher, they're all there. It's not like they've gone away. It's just you need the price action to validate. And we're almost there. Maybe another day.
Yeah, and it's never a good day when gold miners are the only groups leading to the upside. This looks like a pretty classic kind of flag or pennant. Ilya, Dylan, what's the view from Europe on all this? I know I asked that time and again, but I do think it's interesting because you're well connected into the various I wouldn't say political elite there, but you are a well-established business person with his hands in many different cookie jars across the continent. So you don't have the typical industry perspective.
Yeah, I mean, I think this is where Sosnoff is correct, where under the unspoken organizing principle of Europe and China, for sure, but for sure Europe, the unspoken organizing principle of Europe is develop strength away from England because of Brexit. So the thing is, Europe had the benefit of Brexit. And because Brexit was so shocking and alienating in the relationships, the business relationships, I mean, where all of the German money or all the French money or all the Italian money, all the continental European capital that historically had been managed and handled out of London, because that was where the greatest expertise in dealing with money has resided in this part of the world. And so when England passed a law saying that that was no longer desirable implicitly by virtue of their laws with passports and difficulty getting in and out of the country, and you got it, all of the immigration barriers that were stood up, Europe began the process of migrating into itself or within itself and out to the world, but obviously still hugely integrated with the United States. Now you have the United States at least threatening. I mean, we'll see how this actually plays out. I'm still kind of skeptical of how much will really happen. But I would say, to answer your question, the internal dialogue in Europe is self-organize as much as possible and create as many multilateral trade relationships away from America, whether it's with Canada or Mexico or China or whoever, as much as possible. But don't talk about it a lot, because there's no reason to invite more hostility from a very powerful American economy and policy-making body. And I think there's a sadness in it. I know there's a sadness in it, not just among the European business community. So no one in Europe sees the American sovereign credit get downgraded, however meaningless that may be, or no one in Europe sees the lousy bond auction today and feels anything but sadness and concern. You know, there's nothing good for the rest of the world for America to degrade itself. And so it's like watching your older brother create a series of self-inflicted injuries, when really you want your older brother to be as strong and as healthy as possible, because the stronger America is, the stronger Europe is, for sure. And so Europe is, on the one hand, forced into an increasingly non-U.S. organizing principle on the margins. I mean, it's not consequential yet, but it could be in the future on the margins, and then looks at what's happening with this sort of confidence in the American credit on a day like today with concern and disappointment and anxiety.
There's something about the downgrade. I know we don't think it matters, Ilya. This may be one of the reasons why it doesn't matter. This comes from S&P Global IQ. It's the market implied probability, or rather the market implied credit rating, if you look at how actual financial instruments are trading, using credit default swaps as the input here. It gives you a perceived credit score equivalent. So the actual ratings for Moody's, S&P, Fitch, AA+. But if you look at how the market has actually been treating U.S. credit, and you look at the swap spreads, it's been treating it as below that rating for a while now, since the start of 2023. It's been treating it barely investment grade for the past few weeks. Perhaps one of the reasons why the downgrade didn't really matter is because we collectively as the market have already priced in the credit, to a large degree, the fiscal situation here, the spending path, at least that credit markets have.
I mean, it's certainly possible, and, take CDS pricing with a grain of salt after those
highly liquid markets. Yes.
Yes, and of course, ISDA is an interesting institution. You might recall lots of interesting conversations around what is a CDS trigger. When especially we start talking about the sovereign situation in Greece and whether they
I feel my blood pressure rising.
whether they count as a default or not.
Is it a technical default, Ilya?
Yeah. What kind of default is it? It's the inconvenient kind that threatens the architecture of the Eurozone. Right. We can't call that one. Shh. Don't let anybody say anything else. So the market here is a little woolly, but it does speak, I think, to the larger idea. The U.S. is the U.S. There is no supply of risk-free asset benchmark to take over if the treasury market fails. There is no currency of commerce to take over if the dollar fails. That doesn't mean that the market can't go, I want to be compensated for U.S. credit risk because these guys are out there running a difficult game. And what this will mean is it will be a lot of shorter term volatility. So pay me for that risk, right? We've talked about term premium has been rising this year in treasuries. That isn't because anybody thinks that the U.S. is at risk of default. So you look at CDS doing what it's doing, and it's an illiquid version of basically seeing the same thing. It's an incremental change where the markets go, you know what, you need to pay me for this extra risk. That isn't the market saying the U.S. is in fact a below investment grade borrower. Because in reality, the U.S. can go and borrow all the money that it needs at any second. The question is, are the markets telling you that they don't like this and that they want to be paid because the short-term uncertainty is uncomfortable? Well, I mean, that much I think is clearly there.
Yeah, and I know most when they engage with the
I just want to add to what Ilya's saying, which is why,
sure,
for the very reasons that he just outlined, the lack of alternatives, that whole list we all three of us know. Mm-hmm. That's why I actually am not that concerned by today's bond auction. I look at it as a wrist slap.
Sure. Yeah.
Not as a some sort of canary in the coal mine for a soon to implode marketplace.
Yeah, it's not like we're going to see a failed auction around the corner, right? Like, or foreigners stop showing up. I think that was demonstrated.
We might see more of an incentive to wind down the tariff madness sooner than later.
Wouldn't that be a joyful outcome of
that? Would be very, very interesting. Let's say to see the tariff go back to, you know what? Never mind, 2%.
We could just do destination-based
never mind. They'll say, we did the best deal in the history of deals.
Yeah.
Everybody conceded to what we wanted, and so now we're going to take the number down. I mean, no matter what, they're going to claim a mega victory in the best deal in history.
Sure.
No matter whether it's 100% tariff or a 2% tariff, it'll be the greatest deal in the history of all deals. And
that's the one thing that
and a victory.
Yeah, I mean, I think you're absolutely right. That's the one thing
by default.
That's the one thing that stands out here is that the president is a serial killer of sacred cows, including those he raised himself.
Absolutely.
Like for example, the USMCA. It was the greatest thing until it was the worst thing, and never mind that it's his thing. So when you look at this 10% floor on tariffs, they said this is the new floor, but so just because they said it doesn't mean they're going to stick by it. They have no issue unpicking their own stuff. So I suppose it's not impossible if the pain gets acute enough, and I don't think it has, which tells us we need more pain, but if the pain gets acute enough and the put is in fact back in stocks, well, that just makes stocks more vulnerable. Because then the vector for market discipline is not the bond. One of the interesting things here is if the bond is selling off and the administration is sitting there quietly, market goes, wait, I thought you told us this is how you motivate action. It's not. All right, let's go sell stocks. Maybe that'll motivate action. If the put is back in SPY out of TLT, it's a reason for stocks to go down, not up. Because the market discipline mechanism then needs to shift. And maybe that's what we're starting to see. But we need that market discipline. And if we do, if we get it, if we see it, if the red on the screen is annoying enough, then yeah, I don't see why they couldn't go, you know what, never mind on this whole 10% tariff thing. We'll call it 5, no 2, no 1. Wait, we're below where we were. Victory.
Victory. You know, I see TLT as the problem here because it's the way that most traders that don't trade professionally or for a living engage with this. And what I mean by that, I mean your retail mom and pop investors. People have access to the bond market in their portfolio on a day-to-day basis. It's probably going to be something like a TLT or SHI. It's going to be one of these treasury ETFs.
Yeah.
TLT is closing at a low here right now, which is unfortunate. It just creates a scenario.
All of my trades except TLT worked today. Even the awful max loss SPY and QQQ verticals saw some gains today and came off their extremes.
Now they're just 97%.
Obviously, there's a little bit of bleeding for them to do back to break even. So let's go. Let's keep this going. But everything I have on except TLT made money today.
Well, it was gold for me today. I mean, if there's a line in the sand here, let's see if we can cross 58.40 or so. The high from March 25th in ES is 58.37 and a quarter. So if you drop below there, you probably then start to aim for a gap fill that you have for May 9th, which, Elliot, a follow-up on the conversation from earlier in today's session on Futures Power Hour when the market was sitting closer to 2075 or so. A gap fill for May 9th comes in at 2033.10, and we're now at 2050. So you can kind of see a scenario. There's also a scenario here where yields keep moving and stocks keep selling off overnight, and then something happens, gaps are filled, yields back off, equity markets continue their drumbeat higher, and something occurs that gets us back in line. Because again, we are in the territory where Trump himself said bond traders were getting kind of yippy. We're through those thresholds. We're past yippy now. So what comes next? Where's Scott Bessent? Where are you? This shouldn't be happening. I haven't heard Lutnick or Navarro or Ron Vara, for that matter, speaking in public recently. But Bessent, he hasn't said much of anything at all. Dylan, we only have a few minutes left here today, so perhaps dare we have some fun at the boss's expense. Overtime handoff was called off today. That doesn't happen that often. But when it does, it's typically because the market's in a state of drawdown. Now, accounting for all the times that you and I have been bumped for personnel, like I'm not able to be there, or you're going to be running late, you'll be there at 4 p.m., so the handoff is canceled, right? We're just canceling purely for market conditions. That's happened 7 times in 2025, right? Tom and Tony say that it's not a good day for a handoff. You know what the average return of the S&P 500 is if you hold it for a week after the overtime handoff is canceled, Mr. Radigan?
You know, I can speculate as to what the answer might be, only because of the pretext upon which you have presented the question.
What is the
question is, what's better, CNBC marketing crisis special or overtime handoff canceled? We know that the market is up either way. based on the way you presented the question. So the only question, or let's say economists cover, end of the world economists cover, CNBC's special report, market in crisis, or Tom and Tony taking calls, overtime handoff canceled. Which one has the best returns after it happens?
Well, we don't have enough data to say a year out from overtime handoff being canceled, but we do have enough to make ventures into the 1 week and 1 month returns. I will say,
we can always get wildly speculative.
In the very small sample size that I have in front of me, I can tell you that when overtime handoffs are canceled in 2025 for market reasons, the 1 week return for the S&P 500 is plus 2.25%.
So we buy them at the open. Buy them at the open.
Oh yeah, maybe that's the pretense for Bitcoin going up to 135,000, right?
That's what we need. Which, by the way, the cover of this week's Economist. See if I can. Wait. You see that? There we go. Crypto and its swampiness, as per the adjacency to power now in the U.S.
Why it won't end well? It's going to end great. It's going to end great.
I hate to
We're going to rally
through
these highs, baby.
There is no end. Come on.
Dylan, if you're the crypto czar, what's the most controversial thing that you do?
Ban crypto.
Ban crypto.
I like it.
And with that, overtime is out of time.
Yeah.
I think we're going to get
for crypto czar. Dylan
2
Radigan
days
for
in a
crypto
row,
czar.
baby. Walk
We'll
off,
be
one
back
liner.
tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, maybe earlier unless overtime handoff is canceled again. For Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. We'll see everyone again soon. Ilya Spivak's up next with Macro Money. I'm back later with Victor Jones for The Price of Truth. Hopefully see everyone there.
See you there.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
tastylive's godfather of options, Tom Sosnoff, is grabbing his passport and taking this show international. He'll be joined by IG's Rich McDonald in London and Milan, along with special guests at each stop for an evening of live trading. It's fun, challenging, and moves as fast as the market. Doors open at 5, with trading starting at 6. Come early and have a pint or glass of vino with the boys. It's totally free, but space is limited. Register at tastylive.com/events. Options just got molto interessante.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. Like losses could have been catastrophic and they're not.
Cool.
So I appreciate you.
I hear you.
I appreciate you guys. Thanks so
Thank
much.
you, man. And I appreciate you holding on the line to say that to us. So thank you.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on tastylive.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Do you have a long-term trading goal for this calendar year? Do you have any particular trading goal in mind for this year?
I mean, I think you always go into every trade, every year with a goal in mind. I don't put a specific number on it. Take it day by day. I mean, I've never been to one of those alcoholic meetings, but maybe it's one day at a time kind of thing.
12-step program?
12-step program, yeah, 12-step program, one day at a time. Just try to make the most each day. Some days have more opportunities, or at least you perceive more opportunities, and you go from there.
Well, I have a goal. I wouldn't say it's a long-term goal. I have a short-term goal. It's 1 year, yeah. Developmental-wise, I'm past that now. I've reached a point in my life where I can no longer learn new things. I have like a percentage, objective, dollar objective, that kind of thing.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the Tasty Live core strategies.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Inflation is coming back, and it is returning at the worst possible time when economic growth is going in the opposite direction. Markets are starting to get unmoored. We're about to get economic data that's perhaps going to make the situation look worse still. On that happy note, this is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and we are going to delve into a bit of a conversation about what is perhaps the scariest thing for markets and policy makers alike, and that is stagflation. There's a situation where growth and inflation are moving in opposite directions, whereby growth is weak, but inflation is rising. This is, of course, a terrible mix of things to happen, because from a central bank's perspective, it's difficult to say whether you should cut rates or raise them. From the perspective of government officials, it's very difficult to provide some sort of backstop to the economy, even through the regular channels of unemployment benefits and such, because that just fuels inflation. And so the prospect is a scary one, and one that everybody is very eager to avoid. We've heard worries about it emerge in recent days from Fed Chair Jerome Powell, from JP Morgan CEO Jamie Dimon. It's beginning to appear more and more, and although this is a bit of a unicorn of a scenario, it is very, very rare that it actually occurs. The evidence seems to be piling up, and we start with a look at the news that came through overnight. It comes from the UK, where we get a significant jump in inflation. Now, we were expecting to see a meaningful increase, but it turned out to be even larger than expected. The markets were looking, in fact, anticipating that some structural factors in the UK for this month, namely a rise in utility costs, mandated utility costs as of April 1st, as well as a new excise tax on electric vehicles, that would be inflationary, that the cost for water and energy and other kind of utility inputs would rise, and that transport costs would rise, and that this would be inflationary, up from a rate of 2.6% in March to 3.3% in April. We ended up with 3.5%. Moreover, core inflation jumped to 3.8%, also higher than expected. And the retail price index, which is a favored gauge for the Bank of England, it jumped from 3.2 to 4.5 versus 4.2 expected. So significantly higher inflation readings across the board. We can see the reference points for this is somewhere in the beginning of 2024. So these are 13 and 15 and 12-month highs on these measures. Now, this follows in a sequence. We've seen higher inflation numbers out of a whole host of major economies this week. The revised set of European, that is Eurozone numbers, significantly higher, 2.7%, a sharp rise, the highest in 3 months. The core rate in Canada surging unexpectedly to 3.1%. That again has a reference point in early 2024, so a major high there. And we can see how the markets have read the results. So while in the UK the issue was fuzz around, again, what you could shrug off as one-off factors, like an increase in excise tax or an increase in the price cap on energy by the energy regulator. Similarly, you could do the same thing in Canada and say, oh, well, this weirdness in the inflation numbers has to do with an expiring carbon tax, and this will all even out. All of those ideas may be well and good, but the markets are telling you very clearly how they're interpreting these numbers. Front-end interest rates are up for both the UK and for Canada in the wake of each of their inflation reports, which tells you that what you are seeing is the markets downgrade rate cut expectations in the wake of this data. So very clearly, rates higher and the expectation that central banks will have to be slower in any reaction function that they have to any kind of a growth scare as a consequence of the inflation numbers that we've just seen. The story in the U.S. is a bit fuzzier. As we've mentioned, the latest CPI numbers were kind of encouragingly normal at first sight. Most critically, of course, no big surge in goods inflation, something that was a legitimate scare given all of the tariff back and forth. But that seems to now be a mirage, because when we later got the PPI version of the data, as we've discussed here before, we saw this shock decline in month-on-month PPI. And that's even as goods inflation increased and was some of the fastest that we'd seen since early 2023. So the goods inflation seemingly is in fact arriving. The cost of the tariffs is in fact appearing. But then service costs, and we can see this is that big decline right here, suggest that businesses are eating that increase. They're not passing it on to consumers, and they're taking the hit in margins instead. In fact, a 1.6% month-on-month hit to margins, which is quite a thing. That's a lot for a single month. And what you see here then is why it doesn't show up here yet. Businesses are just absorbing it. They're not letting it get to consumers. But the inflation is indeed there. And for what it's worth, we have, of course, seen a moderation in Fed rate cut expectations, where we see that having expected many more rate cuts at the sort of peak panic in April, we've now unclenched, and we're sitting now even a little bit to the hawkish side of the Fed's own outlook. The markets now see 46 basis points this year, 47 rather next year. That's almost exactly what the Fed is saying, 50 and 50. What's interesting, perhaps, is that the cumulative number of rate cuts over the past several days in particular has started to increase, but not because of what might happen this year. So again, central bank action seems to be hemmed in, and rate cuts are starting to push into the further year. They're starting to go into 2026. Now, you don't quite see it in U.S. yields today. They're significantly higher at the long end of the curve, perhaps around all of what this means as an initial proposition. But you are starting to see that the markets are angling preliminarily here to say there is inflation on the march. Central banks are in no position to act now, but they are going to have to act eventually, and perhaps with some degree of catch-up. And this is where the second piece of this puzzle comes in, the growth part. So we got the deflation in stagflation. Here comes the stag. Here is the expectation set for the PMI numbers from S&P Global that are due to come out here over the next 24 hours or so. And we're going to get updates for Australia, Japan, the Eurozone, the UK, and then, of course, the US. And perhaps the most worrying part of this, besides the fact that most of these things are expected to go in the wrong direction, a slowdown in the composite reading for Australia, and of course, just to remind everybody, this is as ever around a center line of 50, where 50 is neutral. Above 50 is growth, below 50 is contraction. The higher you go above 50, the faster the growth. The lower you go below 50, the faster the contraction. And so here, for example, for Australia's composite PMI here, which takes in both manufacturing and services, scaled for their contribution to the economy, we see here 50.7 from 50.1 one would imply that there is growth, but it has slowed. In Japan, same thing, still growth, but near standstill levels, barely a hair above 50. Same story in the Eurozone, although here we're hugging standstill for a second consecutive month. In the UK, expecting a move from contraction to essentially standstill. So not exactly the most encouraging story there. And in the U.S., standstill and at a slightly weaker setting. So the two that really stand out here are the U.S., of course, and the Eurozone. And the reason why these two in particular are in focus is because, of course, these are two of the world's top three engines of global demand. We can see here, we look at this chart a lot to give us context. Global GDP is 58% just three economies: the US, the Eurozone, and China. We're not going to get the China update on the PMI data this week. That one is usually a little bit delayed. We'll see that one later. Next week and the week after is when we start to see those numbers begin to come into view. But for now, we get two pieces of this three-piece puzzle. Moreover, this 42% in the rest of world component right here, most of these economies are dependencies. They're vendors to these economies. They feed demand coming from here. And so, really, it's these three that set the tone. And what we see is already as of April, the overall composite here, this is the global PMI set, that's given us the lowest growth in 17 months. And the concern, looking at this here, would be if of the three big ones, there is ongoing standstill in the Eurozone and ongoing standstill in the US, that May is not going to be much better than April, that we're going to keep looking at anemic conditions, which lines up with how we've sort of developed since the beginning of the year. Last year, we can see already from mid-year, the Eurozone situation and the China situation was going in the wrong direction, from higher to slower and basically flatlined growth, whereas growth was strong in the US and then at the start of the year started to race lower and is now basically lined up on neutral and on standstill across all three of the major economies here. This is, of course, the recipe for what could be a global recession. And that at a time that inflation seems to be perking up. In fairness, this is survey data, but it isn't without backing in hard statistics. Recall that in the first quarter numbers for U.S. GDP, we saw the weakest consumption growth in almost 2 years, going back to the second quarter of 2023. That's, never mind all of these distortions from a surge in imports and a surge in inventories to front run the tariffs, because they don't matter that much. We can see consumption is 68.5% of overall GDP. Everything else is collectively much lower, and the trade side is barely 4.5% as an influence overall. And then, of course, if we consider investment levels, in this case, it would be non-residential investment that would house this jump in inventories. We can see we're talking about numbers collectively below 20%. So we're really focused on consumption as a driver of U.S. GDP growth, and the first quarter gave us a worrying setting. Last week, the soggy retail sales report, despite consumers being insulated, as we just saw in the PIs, along with where consumer confidence seems to be, that is sinking. We're back to levels here lining up with the lows from where sentiment settled in the wake of COVID. And that's as inflation expectations 1 year forward surge, again, feeding into this stagflation story. Obviously, expectations are not realized inflation, but if consumers begin to behave as though inflation is in fact going to jump to 7.3% next year, and they're going to reduce their consumption accordingly, well, then we're going to start to see that show up. That becomes a real economic outcome. And so, as you put all of these pieces together, you increasingly come to the conclusion that if these PMI numbers are leading you to something that the hard data is catching up to, and that something is a global slowdown, perhaps a global recession that occurs in tandem, and at the same time, all these efforts at deglobalization are predictably giving you higher prices. Because indeed, if globalization is designed to reduce friction for goods going, and for capital, of course, going up and down the global supply chain, and that makes things cheaper, then clogging up those supply chains with trade barriers makes things more expensive. So it is only right that in the wake of what we're seeing in the dismantling of global trade, or at least in the hemming up of global trade with significantly more barriers, that prices are going higher. And that growth is suffering at the same time. This is about as stagflation risk of a situation as it gets. Now, of course, stagflation isn't on the menu at the moment in terms of its actual reflection in the economy, but that need not be what happens. It is merely speculation that we are on a glide path there, which would in fact be a nightmarish scenario for central bankers and government officials and markets alike. That's enough. And while it's tempting to say that the turn lower that we have in stocks today has to do with a bad U.S. bond auction or the increase in the U.S. deficit around what may get passed as a budget bill in Congress, it's now sort of making its final rounds in the House, with maybe another between $4 and $6 trillion as a consequence added to the debt. It's tempting to say that this is what's going on, but these are not the types of things that have spooked markets. The U.S. deficit is growing is not news to anyone. That the situation with the sort of rollout of policy is unnerving and building risk premium in bond markets, and that's starting to hurt demand. That's not news. The news that Moody's has downgraded the U.S. credit rating, that's almost laughable, because if the credit rating isn't assigned to the most eligible borrower and is in fact some sort of abstract standard, then what meaning does it have? And is there a more eligible borrower than the issuer of the world's irreplaceable risk-free asset, the Treasury bond, and the steward of its irreplaceable currency of commerce, the US dollar? Those things have no alternatives in the present space. So does it make sense then to say that this is not the most eligible borrower, and if it still is the most eligible borrower, that it's not AAA? That's probably not what this is. Once the dust settles, the upshot here may well be that it is that we're going into a growth downturn that central banks are going to have to allow to fester for longer than would be ideal by a long shot, because what they're going to need to see is for inflation to be broken by demand collapsing, because they are not in a position to act until that happens, to be more forward-looking, more preemptive. And that's understandably a negative growth and a negative earnings outlook mix for risk appetite. And so while we've only just preliminarily started what looks like a turn lower from resistance here on the S&P, if we were to breach these levels here, then the rally in stocks here against the backdrop of this incoming PMI data may well be coming undone in a more lasting way. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio. You can get the Wall Street close and where things may follow therefrom. I'm on with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe and comment. Macro Money is back tomorrow. Happy trading.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, fan favorite Greg Magadini, co-founder of Genesis Volatility and now director of derivatives at Amber Data. Greg, thanks for coming back on the show. How you doing?
Doing great. Thanks for having me on, Ryan. It's always a pleasure to be on.
Absolutely. It's good to see you, and we have a lot to talk about. I think when we last caught up, that was about a month ago, I think April 23rd to be exact. There was a bit more positive sentiment in the market, if I recall. Bitcoin trading back above 90 or so. A lot's changed since then. What do you make of the price action? What are you seeing out there?
Yeah, I mean, we're getting kind of just a nice climb higher in sort of the spot prices for Bitcoin. So to me, this is doing what it's supposed to do type of deal. So I like that. And in terms of the vol markets, there's still interesting opportunity there. We have a very steep contango term structure. We're kind of hanging out right below all-time highs. Implied vol and realized vol are kind of at lows year to date. And I have a hard time not seeing, if we get that breakthrough to new all-time highs to be kind of a mover and shaker type of event. So there's, things might be lining up, like it might be a vol trap too. So keep that in mind. But I think we're getting towards that inflection point where things are getting really interesting again.
What do you make of the low volatility here? When I look at Bitcoin, I've got an implied vol, let's say, closer to 40%, 50% or so. A little bit different when I look at ETH. And then we often like to just kind of measure where that is on, let's say, a 1 year basis, a 6 month basis, what have you, but just kind of get a sense of, where is that within the range? And you look at Bitcoin implied volatility, and as you alluded to, or as you mentioned, it's right there near the low end of the range. At the same time, you've got Bitcoin prices that are pushing towards almost new all-time highs. We've got a range of about 75 to 110 or so here on the screen. But what do you make of the low volatility? Is it here to stay? Is this a reflection of institutional participation and kind of the maturation of the space? Or is it only a matter of time until we're back at 100% implied vol for Bitcoin?
Yeah, that's a great question. I would say your point about the institutional activity, those are kind of the structural flows. I do think the structural flows are a downward pressure on volatility as the asset class matures. But I wouldn't discount sort of the cyclical moments that we can get. Maybe I could just share one of my charts here. I have a chart showing the implied versus realized volatility. So this is the 7-day implied versus the 7-day realized year to date. So just as we talked about, we're really at these year-to-date lows, realized and call it the 35 handle. They're very short dated, implied around 35, as you mentioned, sort of the 30 days more around the 40 range. So this is kind of interesting for a couple of reasons. One is there's the absolute level of vol, but then there's the variance risk premium, which is actually pretty narrow here. There's not a lot of implied premium to the realized, which is usually what you're selling implied fors to capture that. And then something else that's really interesting is if you look at the term structure, the front end here is very cheap, or is the lowest part of the curve. And if I go ahead and contextualize that historically speaking, you can see this chart here. It's looking at the backwardation / contango extent through all the relative markets. 1.0 is a perfectly flat term structure. When we have these vol events, call it COVID or FTX bankruptcy, we get about a 1.32 sort of top formation, which means the front end is 30% more expensive than the mid, which is 30% more expensive than the back, so on and so forth. But today we're kind of at, near that lower end of steep contango. So I do think this is something to keep in mind in terms of opportunities. And if I look at this nice little chart we have here, that's showing us past implied versus current realized, which is giving us the realized variance risk premium. We can see that vol buyers are starting to get paid here on the front end. Back end stuff, 60 days out, 30 days out, vol buyers definitely overpaid for realized, but we're kind of getting a little bit of that turning point in the front end. And I do think if we're making new all-time highs, and we're not there yet, but if we are going to make new all-time highs, once we're in that territory, it's hard to call tops, and I think there's a lot of momentum behind it.
You mentioned a volatility trap earlier. Is that a scenario where, sure, at this point, it looks like we, certainly have lower implied volatility levels. It could be cheap. Is that volatility trap a scenario in which it actually doesn't get more expensive from here, and it could get possibly cheaper on those longer dated options? So even though you're going out, you're buying a leap, you're buying something with a little bit more time, it actually gets a bit cheaper.
Yep. So that's kind of the thinking that I have in mind. I'm more thinking of the medium term to short term. So with that steep contango, you might be tempted to buy 30 days out, 60 days out, but don't forget, you're not only paying theta, you're paying roll down vega on that contango. So as we approach maturities, you kind of have that exponentially decaying theta, but you also have vega points leaking out of the market. So there's a lot of cost to being long fall in that scenario. And then something else to keep in mind is, we've seen these patterns before where assets make new all-time highs. Sometimes they consolidate right below that all-time high for longer than expected, which is very much a vol contraction type of move. So I would keep those things in mind. I'm very interested in sort of the upside, delta upside vega as we're making new all-time highs, as opposed to anticipating a break of the all-time highs.
Okay, so you're kind of waiting then for, let's say we get the break of 110, and then you'd be a little bit more active in terms of going out and buying some of those options if that's your strategy?
Yep, I think that's a better way to play that.
What other strategies would you look at using here, to maybe offset some of that theta decay, or is there anything else that you'd look to do kind of with the current setup?
Yeah, so I mean that's a really good question, Ryan, because you wouldn't know it from my 2 appearances here on the show so far, but I typically like to trade short vol structures a lot better than I like to trade long vol structures.
Okay.
There's just something about, the long vol profitable profile is you buy something and you got to make the 10x, because the other 9x it loses, the other 9 times it loses 100%. So you got to be able to hold winners for a while for the long vol to pay off in the long run. And so typically that's not my favorite type of structure, but as of right now, those are the 2 opportunities that I see. We talked about the long dated IBIT leaps last time I was on the show. That's still a position that I think is really good. And then here, kind of breaking these all-time highs, I like to play the options market a little bit better as opposed to the futures market or the spot market, just because there's just a little bit less spike down risk shakeout risk from a levered long futures position than there is with just a long options position. But in terms of offsetting that, I would still probably keep it simple on my side here with this type of trade.
Awesome. Yeah, since the last time you were on the show, Greg, I actually went out and bought some longer dated IBIT calls myself, and they're working out. I've tried to kind of bounce around in some shorter term stuff, and what's nice about those options, obviously, you've got weekly expiries, but I've tried to offset a little bit of the theta decay. Fortunately, there's not too much in there at the moment, but kind of followed you into that, and appreciate the trade idea. Yeah, forgive me as I bounce all over here, too. I've got a lot of questions for you.
Fantastic.
So when we go back to, well, I guess just looking at what's on the screen here, we've got, I believe this is looking at data that's coming from Deribit. Is that right?
Yes, Deribit data, yeah.
Is it fair to say that you would see or you're seeing the same thing in IBIT options? So a lot of what we're talking about, term structure and contango, some of the strategies that you could use in these environments, would that be applicable to IBIT as well?
Yep, absolutely.
Awesome. I think we got it loading on the screen here.
Yep. Bring this up here. So we can see that kind of term structure here right now in IBIT. And the vol is very similarly priced.
So when you go back to your personal portfolio construction, I know you've mentioned that you typically trade shorter dated stuff, and mostly you're in the options market. Do you carry spot positions? Do you ever trade other derivatives such as futures? Like, how else do you approach the market? Or are you primarily just trading options?
So yeah, there's a few markets that I trade. So I'll trade some equity options here and there once in a while, but I usually trade S&P 500 future options, gold future options, CME yen future options, and then IBIT equity options. Those are kind of the main instruments that I trade. I'll trade some NVIDIA here and there once in a while, but that's basically a SPY option in a lot of senses. And then once in a while, I'll have like an equity bias. But I usually stick to the option market for the exception of very wide markets. If I really want to trade something that's kind of a off the beaten path idea and the equity is just much more liquid, I'll trade the equity in that case. But the reason why I trade options, even for delta plays, is because there's just always a shakeout risk in any type of asset. And I've seen it so many times where you get like this wick that kind of, any prudent risk management strategy would cause you to essentially cover your position. And it's always just hard to get back in after you just got wicked out like that. And that's what I like about options. There's that risk is not necessarily the same.
What about kind of longer term, I guess, investments in crypto specifically? Do you hold positions in anything outside of Bitcoin? Do you have any spot positions where you're looking at this as a longer term trade, whether it's 1 year, 5 years, et cetera? Like, how do you think about that if you trade those positions?
So when I was a younger man, yes, I did, and I had longer term positions. Today, no, I don't. All the money I made in crypto, I put it in real estate and put it in bonds and just use that as income. And the way that I trade my portfolio, I trade pretty aggressively and I take the profits out every year and I put it in safe assets.
Awesome. Makes sense. I'm sure, though, you still have a Bitcoin price target or maybe other price targets in your mind. When you look out, let's say over the next 6 months or so, right? We've had a ton of noise over the last month. Tariffs, recession fears, the kind of ongoing trade war as well related to the tariffs. We just recently got the U.S. debt downgrade from Moody's following Fitch and the S&P over the last couple of years, though arguably, given price action today, it's hard to say that matters much. But when you look at everything going on and you look at kind of the resilience of the Bitcoin price, do you have a sense of, or kind of a view as to maybe how high we go if we do break out? Are there levels where you think maybe now it might be time to buy put options and we're looking to play a reversal? Like, how do you think about the market over the next 6 months?
So I would break that question into 2 parts. There's always short-term trades that I think are interesting, and those are kind of like independent of my long-term bias or thesis. I think the longer-term thesis that I find interesting today, the gold market is at, I think it's around 24 trillion market cap. It's pretty high up there, and gold gold doesn't seem done to me. And again, I still think Bitcoin trades like digital gold. I think there's a few scenarios where the scariest possible thing would be trying to short Bitcoin. And one of those is, do people start buying Bitcoin as digital gold? And I'm talking about central banks, governments. Do we get that there is no offers on the books type of scenario where we get that squeeze higher in Bitcoin? That's where I think, my long-term investment is those, IBIT leaps, at least as of right now. That's what it is. And in that case, I want all that upside. That is one of those, the sky's the limit. That's one of those charts where you look at like railroad stocks in the 1930s and they just did crazy things. That's that scenario in the modern era. Sky's the limit, no price target, just don't get squeezed on the wrong side of it is the thought. In terms of kind of more realistic targets where, does Bitcoin go to 200K, something like that? Yeah, that's like we could grind higher till those kinds of levels, but that's not really the scenario that I think people are kind of seeing could happen. We have like this fundamental shift in the world where maybe the US dollar reserve becomes a different type of world reserve currency. I want to see that play. That's not for the country, but for the fundamental value of Bitcoin. I think that's what happens in terms of making the asset worth a lot more.
Yeah, I completely agree. I mean, I think you're starting to see maybe the early signs of a shift away from, not so much the dollar, obviously as a reserve, but just the idea that the only pristine collateral or within the broader financial system, the collateral that you constantly want to hold is dollars. Not that you won't have dollars, or dollar-based collateral, but you're seeing some diversification away from it. I think to an extent, it kind of explains the price of gold here today and some of the flows that we're obviously seeing into these Bitcoin ETFs. I just came back from Toronto at the Consensus Conference, and as you can imagine, everyone there is super, super bullish, throwing out price targets of 150,000, 200,000. So you almost think that it's maybe self-fulfilling in many ways. But it also kind of concerns me, as a contrarian, when everybody's on one side of the trade or one side of the boat, you kind of look for opportunities elsewhere. Do you see a trade in the short term to the downside? Do you see any room for a correction? And if so, where would you look at kind of in terms of price levels that this might be going to?
I don't. I think right now there's a lot of upside momentum, and I'm not interested in downside trades, and I don't really see them right now, especially with equity assets, risk assets, risk on assets having this nice recovery. There's nothing that I find interesting. There's always you could be in cash trade. That's totally fine. But playing the short side here in this momentum, there's just better opportunities in my mind right now.
Yeah, and I think we kind of already saw it, right? I mean, throughout a lot of these bull markets historically, not that this has been around that long, but previously you do often get these corrections of 20 to 30%. We just had the 30% correction, local low of 75, and the buyers stepped in. So it would be odd to me that you would get an immediate correction. But at times too, I wonder, does this with very low volatility, does this present an opportunity to maybe buy puts as a potential kind of lotto ticket? But I tend to be with you that, you want to stick with the trend here.
Yeah, that's a great point, Ryan. Like, I definitely think still stick with the trend. But if you want to do a lotto ticket trade, like the risk reversal trade is always interesting. You could buy the put, sell the call, delta hedge with the asset. That's kind of a delta neutral position. Nothing happens, no harm, no foul. If you get sort of that crash lower, put vol's going to come in. You'll pick up negative deltas on the way down. That's kind of a nice way to play that. And if we break all-time highs, take that position off.
Well, I hope that we do. Are you active in anything else outside of Bitcoin options? You trade ETH options, or I think there's Solana options and probably many others on Deribit. Is that right?
There is. Yep. There's some interesting trades on Solana right now that I've been kind of pointing out. We've had a big seller of May 31st expiration $200 calls. It looks to me like an overwriter, someone who owns the asset is selling covered calls against it. but they're selling in size. So they sold, I think last time I checked was a block trade of 100,000 calls, something like that. That to me seems like one of those times where you're an investor who sells a covered call, and then like a couple weeks later you regret selling that covered call. I think there's one of those opportunities where taking the other side of that flow could be very interesting. So to me, Solana still has wild card upside in it, and I would not be a seller of 200 calls, even if it's just 2 weeks out. There's just too much risk there. And I think this could actually be an entry on the buy side.
What about ETH? Are you seeing anything there in those markets?
So ETH is very interesting. I like that ETH has been a beat up asset. And if you look at the Bitcoin ETH or the ETH Bitcoin ratio on a weekly chart, for example, the past 5 years, weekly candles, there's a lot of upside for this ratio to keep going higher in ETH's favor. So to me, it might be one of those assets that's very under-owned and we get above 3,000 pretty quick. So I wouldn't discount that scenario. And if we look at the Bitcoin dominance ratio, let's remember Bitcoin is trading as a risk asset and a digital gold asset, whereas all the altcoins are trading more as risk assets. So if we're looking at outperformance in the crypto space in this sort of equity recovery or risk on recovery, I expect altcoins to finally start making up some ground. ETH would be one of those.
Do you think we have to see Bitcoin hit a new all-time high? Let's just throw out an arbitrary level. Let's say 150. Does it have to go there first to then ignite that FOMO and maybe some of the rotation into relative underperformers like ETH? Or could you see, just simply given that ETH BTC ratio is relatively cheap, you could see traders step in there and bid that up to, let's say, 500ths of a Bitcoin? Man, if it got to a 10th of a Bitcoin at this price, you'd certainly want to be long some ETH. But what do you think kind of happens first? I mean, ETH has been, as you mentioned, so beaten up. It's been left for dead. No one's really paying attention. But that said, I mean, Bitcoin dominance is what it is at almost, at 3-year highs here.
Yep, that's a great question. That is, does crypto trade like 2021 or does it trade like 2023? 2021 was really like risk on, rah, let's go crypto. Altcoins did very well. 2023 was more a SVB banking crisis, geopolitical wars, monetary policy hedge, digital gold. That's what's driving crypto higher, therefore Bitcoin leads. I think we're still in the Bitcoin is digital gold, Bitcoin leads higher world. I think those are really the big questions that the world is asking itself in terms of trade wars, global supply chain disruptions, global monetary policy. When does the Fed finally cut rates? Blah, 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 blah. To me, those are Bitcoin narratives. Now, risk assets recovering over the past 4 weeks since the trade war sort of initial spike down. That's been good for altcoins, but I think that's a nice short-term trade. But I think that the narrative in the medium to long-term continues to be Bitcoin-led.
Okay. Bitcoin over everything for now.
Mm-hmm.
Outside of options, I mean, what else do you have your eye on? Sticking with crypto, are there any other themes that you think could emerge, will emerge this cycle? Is there anything else that people are kind of sleeping on? We had the AI narrative for a moment. I don't think that's dead, but clearly it's again been Bitcoin over everything. We've had real world assets, layer twos. What are you focused on, if anything, outside of kind of short-term options and what we've talked about already?
Yep. I think one of the things and one of the themes that we're going to start seeing, so we're going to see consolidation in the space. We had this Coinbase acquiring Deribit announcement hit the wires. That's very interesting. But some of the other unknown things or lesser known headlines, for example, Derive, formerly Lyra, just got an offer for acquisition by SNX or Synthetics. And so obviously there's a lot of altcoins that are governance tokens floating around in the ether. There's an incentive for someone to buy up the tokens and essentially do sort of a acquisition, whether it's hostile or not hostile, but to essentially buy that tech. And when we're in this kind of like, people are not thinking about that environment, I think we could see some more of these types of acquisitions. That's very, very interesting to me. So we'll see what's going on there.
Yeah, that is interesting. I didn't see that at all, the synthetics derived news. So that's pretty cool. What do you make about the Coinbase Deribit acquisition? I mean, clearly it's positive for Coinbase.
Yeah, I mean, I am very excited. I think this is really good for the space. Obviously, Coinbase has Coinbase International. I think for the most part, business as usual, international only, U.S. investors still kind of closed out. But I think kind of thinking down the road, Coinbase is telling itself, hey, we're going to fight that regulatory battle a little bit more for the derivative side. And I think that'll be great for the crypto vol space.
You think we'll be able to trade crypto options via Coinbase, via Deribit in the U.S. soon?
Soon? I'm not sure. But eventually, yes, I do think so.
Fingers crossed. I guess we have IBIT options for now.
Mm-hmm.
Yeah. Anything else, Greg, before we wrap things up that you've got your eyes on? I appreciate you coming on the show as always.
Yeah, thank you so much, Ryan. The only other thing that I have my eyes on are, ETH ETFs that are returning staking rewards. It's going to be kind of interesting, especially if you look at the futures market and the futures term structure of ETH versus those ETFs, those hedgeable ETFs. I also think the Solana futures market is very interesting. That's trades at different valuation than the Bitcoin futures market in terms of futures basis. So I think those are interesting opportunities out there as well. So let's not discount basis trades. There's some good stuff out there.
So is there, I guess really quickly, is there a decently wide spread when you look at the basis trade for Solana futures?
Yeah, so there's a negative basis in Solana futures and or call it a backwardated basis in Solana futures and a contango basis in both ETH and Bitcoin. Now, let's remember that a basis trade is delta neutral, and so you can essentially do some very interesting stuff against those and bet on some sort of convergence, or just wait it out and get paid. Or you could do some sort of relative pairs trade and capture the basis along the way through both of them. So, short the ETH future, buy the Solana future type of thing, get a built-in, call it 7% spread to own that, and so on and so forth.
I love it. Greg, thank you, as always, for coming on, delivering the alpha per usual. Always love to hear your unique insights and take on the market. So thanks again, my friend. Before we let you go, where can everybody find you or learn more about what you guys are doing? And you're doing some great things over at Amber Data.
Yeah, absolutely. So anyone who's interested in looking at some of the volatility surfaces or futures basis or anything like that, you can go to pro.amberdata.io. And if you want some weekly recaps, you can go to amberdataderivatives.substack.com.
Awesome. I'm already a subscriber, so we'll leave it at that. That's going to do it for our show. Greg, thanks again for coming on. I will be back on Wednesday. Until then, I'm Ryan. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
$250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
You know, like when I answer the confirm and send that's
By the way,
in the question.
what are you eating?
Him? Peanuts.
Yeah.
Pistachios.
I ate a pistachio. You're eating and you're just kind of like chewing while he's talking. Like,
No,
nothing.
always. It's
not eating. Do you have some? Do you have some control over there?
None, no.
None.
And there's shells everywhere.
Oh my God, this is so good. I hope you can see this guy. I pray that you can, but I don't think you're going to be able to.
I pray that you can.
I pray that you can. I can't say who, but one of our insiders sent me this. This is Tom. I'm eating peanuts on air, and I don't care face. Here you go.
That's not on air. That's in the commercial.
What do you mean? How did they get it? It's not on
just
air.
made that up.
See? Yeah, that's what we didn't want to see.
I don't. I'm surprised you like. I don't like. Yeah,
I don't like the way you chew your nuts. Okay, I'm gonna tell you that right now.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move. Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
I had a pool like 30 years ago.
Okay, what do you want, a medal?
You did?
Huh?
Yeah, he did. No, indoor pool. It was quite nice.
Yeah.
You had an indoor pool?
1988.
Yeah.
I built it because it was a big warehouse. So we built an indoor lap pool, and it was 40.
The dog loved it.
Do you have an indoor basketball court too?
Yeah.
Wow.
But that was
and a racquetball, basketball.
Yeah, but then, remember, it was a big warehouse, and it was like
No, I don't remember. I was not even alive.
Wait, listen for just a second. I want to go to Buc-ee's. I've never been to a Buc-ee's. I have watched a lot of Buc-ee's TikTok videos over the years, and I have watched everybody do food reviews of Buc-ee's, and I feel like I've never had the opportunity to go into a Buc-ee's because I've never been around one.
Sadly, it's a humongous gas station. It's like the size of a city, and it's super clean. And they've got everything you want, from new underwear to food to eat. 24 hours a day, 7 days a week. It's beautiful. But don't sleep on the bathroom, Sadnov. Even if you don't have to go into the bathrooms. They are amazing. They are so freaking clean, and you can watch the attendant go in after you're done. Like every time somebody's done, bathroom attendant goes in there. It's the most amazing thing I've ever seen in my entire life. It's the best run bathroom in the world. When you're on the road, Selloff, and you're looking to relieve yourself,
I have so much to say. I have so much to talk about this.
Please don't.
Here, he said he was listening to a podcast.
Yeah.
And he said somebody on the podcast was talking about, they knew us, and they were talking about it.
Yeah.
And the person said I don't know who the person was, they were the ones that gave you the beret. And I said, that's BS. I said, I think, but I got to ask Tom, I think it was a marketing company that sent it. I know the Goldfish was. Where did you get the beret the first time?
Where'd I get it?
Oh my God.
Yeah.
I'm telling you, I wish I was in the mafia and he was the only one that saw like what went on. He's amazing. He's great. You'd be a great witness on this.
Great witness.
I got it. I just had it made myself.
No, you did not.
Yes, I did.
Go ahead. Where'd you have it made?
I'll tell you exactly what happened.
Go ahead.
So sometimes like my hair would get in my eyes, I'd like to wear glasses.
Like if the windows were open.
You always wore glasses.
Always. But
always.
If the windows just
Summer,
so people.
I'm explaining. Will you just let me explain?
Go ahead.
So we were coming up with different ideas over what we were going to give away. So we bought things like we got some barbecue sauce that was branded. And we gave away stuff each month. Yeah. So 1 month I decided to make berets. We made aprons and sandals.
Yes, true. Facts. I still have my apron. I have my apron.
Okay. We made all.
I don't think they weren't sandals. They were.
You made sandals?
They were flip-flops. They were flip-flops, not sandals.
And so one of the first things we got was a beret, but I didn't order them because I was like, these are too hard to like stretch.
They didn't fit your head. Be honest. They did not fit your head.
Can we explain how we originally shaped them? We got a basketball. We stretched them over a basketball.
How we originally? That's how we do it to this day. Are you kidding me? We're like an Italian.
And not a WNBA size. It was an NBA, not WNBA.
So that's how I did it.
Get the full scoop by checking out the archives at tastylive.com.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Hi, my name's Angeline Ong. I'm the newest member of the IGTV team. Well, I began my career at CNN Financial in London, covering everything from the financial markets to the European trading day. What I'm looking forward to working with IG is to be the best version of myself and to use all the skills that I have and help IG reach out to those clients out there who are, like me, looking to learn and are ambitious and willing to put themselves out there to learn more about a financial instrument they might not have ever used before. My philosophy is if you're going to play, why don't you play big? Let's not settle. Let's try and learn more and become a real expert in the field that we are trading in. And that's what I hope to bring to IG in its strategy, in its content, and expand that across Asia, the US, and also Europe.
That count was way off. Oh, yeah. What's going on, everybody? It's Wednesday, May 21st, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast. You're a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world, and they're giving us a lot to wrestle with. Thankfully, we get to earn our money. Before we do that, before we get on with the show, let's introduce our very special Wednesday guest, the one, the only, the quarter zip from the gods. We're talking, of course, of Christopher Vecchio. Chris, how you doing, my friend?
Doing well, Victor. I know it's before Memorial Day, but I figured I could wear some winter white before summer kicked off this weekend.
You know how to get the audience, man. Clicks and views. You wear the quarter zip all the way open with no undershirt. That's how you get the views.
There is an undershirt, but our internal testing shows this plays well with the 35 to 55 demographic, particularly among men for some reason. So we keep going with it.
Yeah, for whatever reason, the audience, the demographic of the audience that watches on Wednesdays, very, very different. And I get strange requests on Wednesdays from the Wednesday viewers. Stuff like, hey, can I see your feet? Any pictures of your weird, strange requests from the Wednesday audience. My friend, how are you, Christopher?
No new injuries to report, although I suppose it's traveling through the body now. It's like more of a right shoulder thing. It feels like it's like moved to over here to the right shoulder, so it's better. For
anyone that's not keeping up at home, keeping tabs.
Nah, we don't.
Injured himself reading last week.
Fighting. You said fighting, right?
You said cage match, right?
Yeah.
Ilya hurt himself too, doing absolutely nothing. He didn't even know how he injured himself. And then I said, we're in a certain age bracket right now, my friend. It's time to accept it. You know what I mean? It's time to accept it. It's time to go buy some of those Joe Montana rocker shoes and just call it a day. Pack it in.
Skechers, Velcro, dentures. I'm actually just going to pull my teeth out and get dentures.
Just pull them out. I used to be a sneakerhead, Chris. And I haven't worn, in the last year, I have not worn another pair of shoes except my Air Moses 3000s is what I call them, which there's these pair of sandals, and they actually are Velcro. So from going from 30 years of being a sneakerhead to wearing just a pair of just straight, Jesus 2000s, I've totally changed. I'm wearing Velcro shoes every day. They're sandals, so I can get away with it. But I already wear Velcro shoes. You need to come to my side of the aisle.
Yeah, my wife has asked me. She's like, "Do you want to? What are those things called? Those really shoes that they're like clogs, kind of. Why am I forgetting the name?
Posturpedic, or
I can't believe I'm blanking on this right now. Oh my gosh! Telling my child, please go slip on your
orthopedic shoes.
No, they have all the holes in them. They float on water.
Oh,
Crocs. Yeah, my wife keeps asking me like, I don't. She's like, do you want a pair of Crocs? I'm like, honey, like I can't become a Crocs person this early in life because I won't ever take them off.
First of all, you have no idea how popular those are. I bet at minimum 30% of this chat wears Crocs, and you see them everywhere out here. Everywhere. Yeah, everyone wears Crocs here.
Yeah, everyone wears Crocs. I mean, particularly for someone who's coming from rowing, they were great because if they fell in the water, they would just float. They wouldn't sink like your other regular shoes. So, but I would wear those all the damn time. And I would wear them to black tie events. I'm in my Crocs. I'm picking the kid up from school in Crocs. Funeral. Why the hell is he wearing Crocs again? So you don't want me doing that.
I don't get invited to black tie events anyway. I'm not exactly black tie event material. You know what I mean?
Yes, you are.
Oh no, I'm not. No, listen.
As am I, but I usually go as the help.
I know what I am. I am not black tie material. I'm telling you right now. I'm totally socially awkward in person. That's first and foremost. And then if I do come out of my shell, it's because I've struck up a conversation with somebody about the end of days and what you can do to protect yourself. I'm not black tie material. And furthermore, I'm the guy who doesn't wear the black tie to the black tie event. I will wear a black T-shirt and my
with the tuxedo on
Velcro sandals. the black T-shirt tuxedo shirt, or the black tuxedo shirt.
Honestly, if you want to set up a Cameo account where you do cameos wearing a black tuxedo shirt, I will be your first happy customer.
You know what? I would do a Cameo just for free, not for money. Because I'm never, the whole subscription game and all that. It's never been my thing. So, but I would do cameos for free.
Maybe that's your new business line, Victor. Like, I will show up to your event in a tuxedo T-shirt.
I'll just do people's answering machine. Go, oh yeah. And that, my friends, is the cold open. Shout out to everybody on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the chat that's already on your screen, thank you, production. You know the game. You just got tired. You want to be part of Jump the Gun a little bit. You want to be part of the chat boxes in the middle of your screen. There's only one place to do it. And that, my friends, is over on the tastylive YouTube channel. Head on over there, subscribe to the channel, and your thoughts, both appropriate and otherwise, will be featured in the middle of your screen. There is no filter. So just do with that whatever you will. Do with that knowledge whatever you will.
Based on Victor's Twitter feed, he'd really like to know your opinions on Jake Tapper's new book.
Bro, why would you do that at the beginning of the show? Why would you do that at the very beginning? Did you see Megyn Kelly's interview with him?
No, I'm not engaging in that.
Why not? You're not engaging in what? Megyn Kelly or Jake Tapper and his attempt to pivot?
I will not give them views.
Who?
Not buying
Which
the book.
one? Both?
Jake Tapper. I'm not buying the book. I'm not paying attention to this media circus. Like clearly trying to.
Fascinated, bro. I'm fascinated by just the pure audacity. You know what I mean? I guess I was raised just differently, you know? There's no part of me that could do what that guy did and then try to do a pirouette and try to sell a book the way he's trying to sell a book. There's no part of me that has the audacity of character to try to pull that off in public and pretend like all these people don't know what's going on. Like all these people didn't watch you on television. It's the audacity that I'm fascinated with, Chris. I cannot believe it. Bro, he should be, all right, why would you do this at the beginning of the show? He should be fired, man. That guy went to Dartmouth. If that's what a Dartmouth education gets you, a person who can watch a person who's completely infirm to go, oh, I have no idea. His inner, and then make up this whole story about this inner cabal that lied to you. It's like, what are you saying? You know what I mean? What are you saying?
I mean, there's two glaring implications there. Like, right, so this is all information that they've had in a book. Books take time to write, so this is information that they've known for a while.
Yeah.
We're supposed to trust you in reporting the news, knowing that you sit on some of it for personal financial gain is an interesting. It's an interesting angle. One, two, I recall a lot of air cover being given, but secondly, like, talk about accusations of the deep state. They're going to weaken at Bernie's Biden for the second term, keep him out of the public's eye, and hope that it's really about the team that you elect, as one person who said. Like, that's gross. That's really gross.
You know what's interesting?
It's gross all around. So I'm just not engaging with it. I have better things to do. The Knicks are playing tonight. The Knicks are playing tonight. That
is the healthier way. That's the healthier way to be instead of rage watching a 2-hour interview with Megyn Kelly going like, yeah, get it. That's such a healthier way to be. You know what I was thinking about though yesterday is that this weird thing is happening where everybody's being confirmed in their prior held belief. And I think that's actually really dangerous in a way. So like, for instance, the whole thing that I think one side of the aisle, I don't even think it was a political thing, but I think a group of people generally saw the former President Biden in a certain state and said, this is not a good idea to be having a conversation about another 4 years. Let's talk about another option. And it wasn't disrespectful. It was just like being objective. Those people were lied to and gaslit. And now months later, they're like, okay, you were right. And they're like, yeah, I know I'm right. And then there's a group of people who are like, you know, Trump he's a self-dealing businessman. Doge is a bunch of bullshit. They're selling hot air. And those people 3-6 months later are being validated in their prior held views. So it's like these group of people that are diametrically opposed. In some ways, we are living in a world of confirmation bias and we're just seeing different realities. But in other ways, objectively, both sides are being proven right. And the problem is we're not understanding that these two things, we can have ideas that are not mutually exclusive. So we're arguing with each other over ideas that are not mutually exclusive. And that is a very dangerous world to live in, because when you're both right, you're confirmed in your prior held beliefs, which only makes you double down in your arguments. And both sides are using truisms against each other. It's like, bro, you guys are either using falsities to argue with each other or truisms. And both of those things are not good. And I just thought about this. I'm like, both of these people don't understand. They're actually being validated and that just creates more polarization. Anyways, you just kicked the hornet's nest, and you knew it. You knew it. You knew what you did to start this show. Chris Vecchio, 5,855. They spooked him a little bit, but at the end of the day, S&P down 1 2/3%, a little bit off the lows. The Nasdaq down 1.3%. The Dow Jones almost down 2%. The Russell just demolished nearly 3%. But again, pretty decently off the lows here. Your thoughts on risk here today, man? Is there a narrative behind this risk? I'm sure there are. There always is a catalyst. Or do you really just think at some point 6,000 markets are going to get a little skittish? And right now we're in a test of the conviction of the market. The loose hands get shaken out, and you get a test of the conviction of the market here around 6,000.
I don't know if it's a function of weak hands up here. I think it's the new reality that Treasury yields just crossed the threshold that makes people uncomfortable. 10s were capped at 4.5%, 30s were capped at 5%, and with today's 20-year bond auction, those thresholds are obliterated. So all of a sudden you go back into a 2022 mindset if there's a proper corollary for recent memory, where in a world of higher for longer interest rates, what do you value and hold near and dear to your heart on the totem pole? And small cap stocks that are 2,000 of America's worst stocks in the Russell 2000, as I like to jocularly joke, of course, those companies don't have the moats. They don't have the cash flows. They tend to have a lot more floating rate debt than their S&P 500 counterparts. And so yields up in Russell leading to the downside. Regional banks getting slugged the most. They were the ETF leader among sector ETFs today, by the way. KRE down like 3.56%, I believe. No bueno. I think that's just the world that we're now in. We're back into the higher for longer territory for rates. That's about 4.5% to 4.8 on the 10s, and that's 5 to about 5.25% on the 30s. So uncomfortable territory up here for the foreseeable future, I would guess, given the state of the tax bill and its current trajectory in the near term.
I do agree. That that auction kind of spooked some people.
Shaved a full point off his EB basically right after it.
Yeah, and I told everybody I've been trying to play this too cute thing, that like I'm trying to go a little bit long bonds here because I think it's the contrarian's contrarian play.
Same.
But I also said that it would not, so I didn't want to go long bonds outright. I wanted to only do this play with upside options, and it's because I have a little bit lower conviction, and I know, and I also thought if I'm wrong, I'm going to be wrong big. And the reason I could be wrong big here is because if what's happening in stock prices is validated, you're going from everyone being nervous, sort of positioning for potential growth slowdown, positioning for potential recession, and recession calls got up to 60%. If you're going to price that out to 30%, and that's real, what should theoretically happen is twos have to come higher, because why would you be cutting 4 times in a year if you're not necessarily at a 60% recession outlook, if you're down to a 30% recession outlook? And you've seen that repriced. And I thought what would happen then is the long end should come down. You see a little bit of a flattener, and we actually did see that. We went from 67 basis points to 45. But now, so what should happen with the longer end in this scenario? If the market believes that, believes 6,000, it believes equities. In theory, you could get a higher long end just on repricing of growth and inflation. That's it. And I also think like higher long end yields don't necessarily, it's not a bad thing, but it has implications. And do you see a world where yields could keep going higher and stocks can stay where they're at or actually move higher as well?
If we recall the price action in late 22 and early 23, what was the analogy? It was the hurricane analogy. Okay, so just re-anchoring my chain of thought here. At the end of 22 and the beginning of 23, one of the analogies that I used about the action in the market, and even going into 24 for a time, was that like when you first move to Florida and you're there for your first hurricane, it's kind of alarming. You kind of over-prepare for it because you've never lived through a hurricane before. After you live there for a decade, you kind of know what to do. You know when to take it seriously. You know you don't need to buy 10 cases of water at Walmart, right? You know that you don't need to buy 400 batteries. You have learned the approach. And so the corollary there was the first time the market saw the 2-year yield hit 5%, it got really spooked. And on the second time, it was a little less spooked. And the third and fourth and fifth iteration, every time it was like, okay, we know that this isn't the end of the world. It's just another storm that will pass. This is like the first hurricane now. We haven't been back in this territory in this context window in some time. And I think that's what's important because ZB hasn't broken its yearly low if you're looking at ZBM5. ZN certainly hasn't, but it feels different up here right now. And that's, of course, because we have the backdrop of the tariffs, which may be inflationary, one-off, but perhaps structurally inflationary. It could reduce growth, but we do ultimately see that does pose potential questions about foreign demand and interest in U.S. Treasuries long term. After all, they're just recycling U.S. dollars back into our debt to keep the wheels spinning. That is certainly up for grabs, right? But even if we back away from that with the 10% tariffs and the pause and the yada yada, we're still talking about a new government spending bill, which, Victor, as you and Ilya were discussing yesterday about Doge and its, I would say, disappointment in terms of achieving the stated goals by Elon Musk, who outlined a $2 trillion spending cut target and fell exceedingly short of that. I would point out that this is going to bring $4.2 trillion in new government unfunded liabilities with an additional $2 trillion on top of that just for interest expenses alone. So deficits compared to where they've been are going up. If we have higher deficits, we have greater funding costs, more supply needs to come into the market, greater issuance. And so just by a force of nature, Treasury yields by what appears to be the path of least resistance forward on fiscal policy, you're probably going to need to see, well, more supply. And the market today got a 20-year bond auction that was gross. Bid to cover ratio below the 6-month average. It tails. Excuse me, it doesn't tail. It doesn't stop through. It ultimately tails. Right? Ugly, ugly, ugly. People just didn't want to show up for it. So I would think then when I say in the near-term path, because if we do go into recession and push comes to shove, I think things will settle out. There's a vote potentially tonight or tomorrow about bringing the current tax bill to the floor, if this is the current driver, because I certainly think it is. I don't think it's the downgrade. But if this is the driver, there's a vote to bring this to the floor, broadly speaking, in the next day or so. It could be tonight, probably tomorrow morning. If that occurs, you may get a broader House floor vote on the current tax bill, maybe tomorrow night, maybe next week. But Johnson says he wants to have it done before Memorial Day in the latest reporting. That's probably going to be the exhaustion point if this is the reaction, if this is the catalyst, for everything that's going on right now in the bond market. That's probably the exhaustion point. And I say that because no one's paying attention to anything going on in the Senate side of the equation right now. John Thune and other Senate Republicans are singing a completely different tune when it comes to the budget, about Medicare cuts, about SALT, about this, that, the other thing. So they're going to take the House bill, hack it to pieces, send back a revised version to the House, and then we're going to go through this all over again. But the Senate is probably not going to tee up this kind of spending and this kind of taxation and this kind of whatever this is right now that's leading the market to be panicked. So I think we're going to have a real-time test of this theory in the next few days. If the bond market is being driven by these headlines in D.C. regarding tax legislation, then we'll find out if we're reaching a crescendo here in the next few sessions, in my opinion.
To me, I think there's no – I think they are related. I think they're definitely related. You can't tell me that the timing of the Moody's downgrade coupled with a shitty 20-year bond auction, you can't tell me it's completely uncorrelated to what's happening in the House right now. So I do think it's correlated. It's not even a, let me respond to the question the premise I'm giving you, that the $4 trillion has to go somewhere. This is what I think. Like, yes, it should have an impact on the bond market, and yes, the cost of capital impacts the net present value of future cash flows, but also that $4 trillion and that run rate that run rate it creates of a couple $1 trillion or $2.5 trillion annually or something like this, that's going to go somewhere, and the market is going to price it going to somewhere. And that's why I think like this is a little bit different than 2022, because 2022 it was higher rates and then it was ceteris paribus. And what ended up happening is the government came in and spent a bunch of money to help to offset the impact of those higher rates. But the market in 2022 was not anticipating that was going to happen. So it was saying all else equal with these higher rates, this is what equity should do. Right now, they're going, okay, we should get higher rates given the fact that the government still wants to spend like drunken sailors, but also I know that money is coming, so how do I price equities? And that's the only small caveat I will give to higher rates in 2025 and their impact to markets versus higher rates in 2022 and their impact to markets. And I think what you're saying about the Senate having a completely different posture is really important. Do you think that we're setting up in a way for like the Liz Truss moment for this administration?
I've been pondering that a lot recently. I've brought it up a few times over the past few days here on the network. Yeah, if only because the structure of our government is so different than what they do in the UK, where there's a natural flush mechanism in UK politics, parliamentary politics, where the people can just say, you know what, we don't want this person to be prime minister. We're gonna take her back. We're gonna send someone else from the party because we still have the majority to the forefront to lead us. And that's what happened with Liz Truss, right? She gets taken out. Her policies are put back into the tube, and the market calms back down. Trump's an interesting figure. No one seems to be putting up any sort of resistance. So if it's going to happen, it has to come in the levels of the Senate where, we'll say the populist whims of MAGA haven't overtaken the operating apparatus. So the apparatus that controls the levers of leadership there, which is, I would say that the House is more MAGA than the Senate. I don't think that's a controversial opinion. Okay. And that's just by nature of design. It turns over every 2 years. So it's a lot more responsive to what's happening in terms of reformation and realignment of different political parties. But to that point, if we think about what's going on with the Senate here, I mean, Victor, there's a fight that's going to be had there. They're going to give a lot of Trump what he wants. They've already passed the No Tax on Tips Act, which, by the way, I suppose we should be having a conversation with Tom about.
I know. I would like to get paid a 95% tips, please.
I would like to be paid the minimum wage, and at the end of every day, you can Venmo me my tip for the session.
No. If you work for tips, you can work for sub-minimum wage. I guess it depends. Some places pass laws for the sub-minimum wage rule.
I'm in New York. Yeah,
I'm in Chicago, so I guess you can't there either.
Yeah, well, we have SALT coming our way, so I suppose that's the extra I mean, I ran the math. It's going to save me thousands of dollars a year. The current tax bill. The current tax bill is complicated, right? As it goes through in its current form and function, you're probably talking about for people making less than $50,000 a year, it's going to result in about $850 less in your pocket actually per year. The sweet spot is if you make around $350,000 a year, then it's about a 3% bump to your overall income. But if you're making less than $50K, it's actually more money out of your pocket. So, SNAP is, SALT is something that disproportionately benefits the Vecchios and the Jones and the Sosnovs and the Batistas of the world, given where we live.
I don't know. I think I said this yesterday.
Do you own property in a high blue tax state or high tax blue state? If the answer is yes, then you're probably going to be helped out by this.
I don't understand why. I said to Ilya yesterday, I go, who gets excited by this? It's like you're pissing off your fiscal conservative. You are pissing off your base, not all the base, but some of the base, the sort of the low end economic participants who probably in many ways switched their political affiliation for the first time in many elections to support something as what they were voting for previously was not helping, and now all of a sudden you show up and you're cutting SNAP and Medicare. It's like, who exactly is this designed for? And you're going to, I think, lose a lot of goodwill the more this goes forward. It doesn't seem like there are a lot of people up in arms right now, which I find strange. I would think everyone would be pissed off at something like this.
So let's split that in two and let's work backwards. There are definitely people up in arms and upset about Medicare, Medicaid. I know Democrats are pissed off about it. There are protests all around the New York City metro area and surrounding counties and towns and cities every single weekend for months now. Okay.
I think they'll resolve that.
The Medicare stuff and Social Security is just like a third rail. The Social Security stuff blows my mind because it's not even the government's. I mean, none of it's really the government's money, is my personal point of view.
There's cuts to Social Security?
No, they can't. No. But I'm saying people they bucket like SNAP, Medicare, Medicaid, Social Security as kind of like that third rail of politics, like the very bottom layer of the social safety net that we all agree should remain there. No one really touches it. We all talk about fixing it because that's where all the money is. But like, you don't actually go after it because you go after Social Security. That's money that we give to the government to basically be a custodian of in a pay-go program, and we get it back because that's our labor and time. And so you're going to say, oh, by the way, you put all this money into a program, you're not going to be able actually to use it, even though you trusted us with it. No, it's electorally death. I think it polls at like 95.5, right? So like that's not going to occur. But the SALT thing, you were saying, who does this help? I want to talk about that very specifically. This is what both parties miss by this whole distorted era of gerrymandering, where most politicians are simply in power because they have districts that cater only to a majority of constituents on their side of the table. You have very deep blue places, you have very deep red places, and these are the loudest voices in our politics right now because the purple areas have shrunk and shrunk and shrunk. And so let me tell you, as a resident of one of the purple areas, we voted for Kamala, we have a Republican congressman, same election. Why did that happen? Well, why are you doing SALT? Because you have to give people like him something to run on to keep moderates in a purple area inside that tent, that split ticket vote. And if this guy comes out of a negotiation and says, by the way, we're taking away Medicare, we're taking away Medicaid, we're jacking up your taxes, vote for me again. What does that do? The power in the country is not held in deep blue New York City or deep red Texas. It's held in the purple places. So you're going to have to do things if you want to hold on to power that piss off your base, that cater to people in the middle, that do things that are like, this isn't going to make the people on MSNBC or Fox News happy. Quite frankly, I think if we can have a policy that makes the people on Fox News and MSNBC unhappy, it's probably going to be good for more people because it means both extremes are pissed off. So the SALT stuff, who does it benefit? Benefits me, benefits you, benefits Sosnoff, it benefits Batista. It's not going to help anyone in the bottom 80% of income earners in America. If you're in a household that makes less than $149,000 a year, it's not going to help you at all whatsoever. So everything else, though, I don't know who it helps, Victor. I don't know who's out there clamoring to cut SNAP. That doesn't make sense to me.
No, I'll tell you who. Have you watched the last episode of All In, the All In podcast? Friedberg.
No, Victor.
Friedberg has a moment in there where he's complaining about the bill, and he's pissed off. Okay. I'm like, okay, I generally, because he has a scientific approach, he doesn't speak much. I don't watch it that much anymore, but when he speaks, I always really like to listen to his points of view. And he's also been just as concerned about the deficit and the debt trajectory as I have. So I'm like, okay, let's see what this guy thinks. And what he was most upset about is that the cuts to SNAP were not deep enough. He thought they were not deep. I'm like, how is that your point of view, right? SNAP is, and I said this yesterday, it is less than 2% of the total federal budget. Defense spending is 13%. So in his whole rant, he brought up the need to cut SNAP deeper, never once bringing up that I think they increased the defense budget by like $160 billion. So the big elephant in the room, you completely ignore. You pretend like it's not there. You don't talk about that gigantic line item. And by the way, the people running that part of the government have failed audits 5 times in a row. They're completely unaccountable for the biggest part of the budget. But over here, the 2% that is being used to feed people food insecurities, you think need deeper cuts. It's like, how can we both have budget concerns, but your concern is about the food security of the least in our society and needing to cut that deeper to the bone. And mine is like, the billions of dollars that we're spending, to run this like just gigantic. Anyways, there are bigger things that we could be talking about in terms of spending. I just could not believe it. I could not believe that's the hill that you want to die on, to cut deeper from this thing that only makes up 2% of the federal budget.
Just to put that into perspective here, knowing these numbers, SNAP is about like 110 to 115 billion per year, and they want to cut that back. Defense spending is north of 815 billion a year, and so they're talking about now they're talking about an increase in defense spending that's greater than the entire supplemental nutritional assistance program budget. So there's a way to explain this, where you took the money from hungry kids and poor people and to build bombs.
Yes.
To kill hungry kids and poor people.
Yes.
What the?
Wait, what? I don't know.
You know the expression like, this terrorist attack happened overseas, like so and so is going to learn why Americans don't have health care. Again.
The healthcare thing is a different thing to me.
Well, it's just a joke. It's a meme, Victor.
I get it. I take things too literally. I'm telling you, that's why people don't invite me to the black tie party, because I go, no, that's not true.
Yeah. Last week you sent me a text. You're like, what are you going on Twitter about right now? And I'm like, I don't know, the Knicks game. Like, what are you going on Twitter about right now?
We're gonna do this live on air, because I was like, I think you were trolling me a bit, but in the moment I didn't get the vibe of how you were talking. You know what I mean?
Yeah, text is a very good medium to convey different tones, as is famous.
All right, man. Let's keep going. Bitcoin to the moon, baby. I had yesterday. Did we hit it today? Oh shit, we did.
New all-time high.
We did. I had yesterday, or I think it was yesterday, maybe it was a couple of days ago. A couple of days ago, I said we did an over-under. How many weeks until we hit an all-time high? I think we were at 105. And I said two weeks, no more than 2 weeks will be at an all-time high. And we hit it today. And I think this is a one-way train, bro. You can't be talking about $4 trillion deficits in failed auctions and not think you're going to be at all-time highs in a scarce asset, man. This is, I don't want to over-rotate, man, but I don't see how this. I forget what my total number was for the end of the year, but I think it's totally in the cards to be at 125 sometime in the near future. I don't think that's crazy talk, and I'm long a bunch.
Pessimistic.
Yeah, what I say? I'm long a bunch of IBIT upside calls, and I think they're nice. The 60s, 65s, and 70s. And I think they are printing. I think they're going to keep printing, man. This is probably a bad spot to put new stuff on.
No.
But when this thing gets moving, it just goes and goes. It never gives you a chance. When Bitcoin starts moving, it goes and gets to wherever it was going to go. Your high price, it gets there right away. It's not going to give you a pullback. And that's the wild thing about this market. So I think wherever it's going, we're going to get there fast.
I am with you. It's one of the trades that we talked about in overtime today. To put in the tastylive fall account, long 70, short 80, call spread in IBIT, 58 days to expiration. That's the equivalent of we're going to look for a move to 135K in Bitcoin. Excuse me. The simple perspective, as you and I have exuded or explained a number of times over the years, I think even Ryan Grace has talked about this. Bitcoin is a very clean market technically. And so I would point to the recent chart action over the past year and a half where we had this big explosion higher post-election. Pull back over the next few months brings you where? To about 74K, former highs. And then we rally back up. This is a stair-step pattern, a typical bull flag. The measured move, swing low, swing high, back down to the recent low, gives you a touch point of 135K or so. I think that looks really good. So for the sake of having a trade that's not me bottom fishing in bonds and getting repeatedly kicked in the face, hodling, cryptocurrency aside, tactically right now, crypto looks like it has another leg higher. And what I would point to, Victor, is that where are all the celebrations? Where is that guy, Nick whatever, who has those terrible glasses and always posting those obnoxious videos from his boat in Miami or whatever? Where he was all over the place in December and January. Where are the people who are counting down every $1,000 milestone in Bitcoin and quote tweeting themselves 93,000, 94,000? I can't believe
you're not going to see that until the market needs exit liquidity, bro. You're gonna figure out how this works one day.
Oh no, I that's my point.
I know you.
We're not there.
The audience is going to figure out how this works. Just yesterday, there were like Wells Fargo comes out and they say, buy stocks, whatever, and I'm like, yep. All right, we're getting close because when you get those institutions that start pumping certain assets, they're stuck, and they need exit liquidity. Not always. I'm kind of being a bit of a conspiracy theorist, but I'm more right than I am wrong in this game. Like if you're listening to those big banks, and in listening to what their calls are, and you think there's a real separation between their analytics department and the trading side of house, then you just, you're pretty naive. And when Bitcoin was at 80, 90, 100,000, you saw it everywhere, man. And what do you get? You get a puke from 80 down to 20. And then nobody talks about it. And then all of that accumulation happens from 20 up to 100, and we're going to keep going, man, because institutions are now starting to acquire. Nation states, sovereign wealth, all starting to acquire. And you're not going to hear anything about this thing until they all need exit liquidity again. That's just how this works.
There's no need for it right now because everyone jumped ship back in January, right? Maybe they accumulated again at the lows. But the reality is this has been and you and I have talked about this for several weeks now, even going back to mid-April. Bitcoin holding up, gold holding up, despite all the chaos. Stocks up, Bitcoin up, stocks down, Bitcoin up. And that was in the 80s. And how this thing just relentlessly marched higher very quietly the last few weeks. So now it hits a new all-time high. And now the fun begins when people come out of the woodwork and start to pump it up and yada, yada, yada. But also we've pointed to the global M2 money supply as something that a lot of Bitcoin watchers look at as a potential leading indicator for where prices may go. And if you advance it 6 to 9 months ahead, you'll see that it's been tracking it pretty neatly right now, Victor. And it still has room to run to the upside. So I like the technicals. I like the backdrop of unsustainable U.S. deficits and debts. I don't know if that's a real driver for Bitcoin, but I know enough other people do. And that's a real important part of the crypto market. There's enough people who believe in things, kind of like technical analysis. What's the importance of a 100-day moving average, Victor? Is that any defined period of time? Is that 3 months or 6 months? Or no, it's just a round number that people look at. And because enough people look at it, it carries some importance that we all end up having to pay attention to it. So you got to just ride the waves. Don't be a hero and try to fade momentum in crypto. Crypto is a self-creating, self-consuming mechanism.
I mean, there are some things you can fade. Crypto, I think maybe once or twice in my lifetime have I even tried. And maybe if I've tried twice, I've been 50-50. So it's not a thing that I try very often. But fading momentum to the upside, fading when nobody's talking about this asset for the lifetime of its existence has proven to be a decent strategy. You're getting the little rat. Please tell me you're still long. Are you still long gold? Or did you pitch it? Did you pitch it?
No, I was short, and then I got back long, and then it started peaking below 32, and I was like, oh, this is making me feel really uncomfortable. And then, we had this price action this week, and I said, okay, I'll still stick with you for a little while longer. You haven't let me down.
Still got it. Good.
I got it.
So you got a nice little rally into your position here. They dumped all the gold miners last week. They got super cheap. They brought them back up in like 3 days. So I still think they're probably, it depends on what your time frame is. They have some long-term value here. If I could step away from our typical, going across the horn on the macro instruments,
sure.
Is there anything that's been piquing your interest as of late? Any themes, any underlying instruments, any sectors, any correlations that are piquing your interest as of late?
Yeah, I think I've been certainly looking at this, but I think we need to have a conversation more in depth, not necessarily today, but as market participants moving forward about some of these phase 2 AI names, which have really started to perk up and percolate again. Some of the names in the basket that you and I discussed a few months ago, like an SPGI or an Axon, really did well in the post-Liberation Day recovery, quickly returning back to their highs. But we've also had some good news, like what was holding up the NASDAQ report today. Alphabet, Google, whatever, what are we calling it these days, up nearly 3%. It was up more, but making further steps forward with their AI program. And I think it's been previously discussed here in other places on the network that they actually have a very impressive LLM right now. So the fact that they're taking steps to monetize it moving forward is a good thing for the bottom line. In any event, AI is still very much in play, okay? And as Elon Musk pointed out yesterday, we're reaching a bottleneck where we're getting to the point where the scale is too great for the current electricity supply that we have. Mm-hmm. Now, what does that mean in the short term? Does that mean that natural gas prices should be a lot higher? Perhaps. People should read through the Republican legislation that's currently making its way around the Hill. One of the reasons that I really dislike it is because I am pro-nuclear. The current tax legislation undoes a lot of the Biden era efforts to bring forward tax credits and incentives, stimulus, grants for new nuclear energy generation. And it's undoing a lot of that right now. So it actually, as a lot of the analysts in the industrial sector are saying, building new nuclear plants would actually be more difficult moving forward if this legislation is passed into law. It becomes more costly. There's going to be more delays. It's not the permitting reform that people were hoping for. In fact, it's more onerous. So that creates the supply bottlenecks. Part of the AI phase 2 story would, of course, be utilities. Utilities tend to do well in defensive market environments. I've had my hands on Exelon EXC as a potential longer-term target. I've been riding long 42, short 47 call spreads for several months now, and those are still working out for the time being. But I want to roll those forward. I still like exposure here longer term. I think I may try to get some upside convexity, though, and on pullbacks begin to build into a position that's like long the 48, short the 52 call spread, somewhere in the neighborhood of like 121 days to expiration looking at September. If we're going through a potential, market getting spooked again, I'd rather have my chips on the utility side of the AI table than anything else. But these names overall have held up, and they led the rebound, by the way. That is what's important to me. It was a lot of the tech AI stuff that led the rebound outside of those, off those April lows. Probably good news if this market keeps going up.
Yeah, I agree with everything you said, and I've been long uranium and nuclear stocks for a while, Cameco being one of them. It's one of my biggest positions, and luckily I collared a lot of the risk, the downside risk, not all of it, but a lot of it, and it's going parabolic again off of its lows at 35. A lot of these uranium stocks are. And it's that second derivative play. So if AI, the whole narrative, cools down, the second derivative cools faster. So it has higher beta to that to AI in general. And you're seeing it pick back up. And I think there's probably that same thing exists. It's less talked about. That same thing exists in basically water right now. Nobody really talks about this aspect, but it takes a lot of water for cooling in these data centers. And so there's there's different utility companies that you mentioned before. Some are on the energy side, some are on the sort of the nuclear side, SMR being one of them, like small modular reactors. But then there's also this whole water aspect to that narrative. And a lot of those water charts, the underlying water utilities, those charts look really, really good. Some of them got cheap a little bit, but for like 2 years, these things have really ripped to the upside. And I sort of like the theme there. The unfortunate thing is, like, I'm not saying this at a time when any of those particular stocks are cheap. I wish I was bringing like a new idea to the table where you had deep, deep value in a lot of these underlyings, but you don't. And a lot of them are regional as well. So if you're going to buy a certain company, you're not buying like the overall theme. You're buying, water for California in AWR's case, or AWK's like New Jersey and up the East Coast. So but generally, this is a theme that I've been researching a lot over the last couple of weeks, because I do think it's like sort of that third derivative play of, all right, you like AI, a bunch of CapEx is going to go into AI, a bunch of sovereign wealth money is going to come here and elsewhere to build this shit. Yes, you need energy, but you also need water to cool. And the water part, nobody talks about yet. But I think that could evolve over time to be a mainstream theme. But once it gets to become a mainstream theme, that's probably when you're going to want to start dumping this stuff. And I don't think we're early in this. We're probably somewhere in like the middle of this evolution of this theme. What about biotech? I thought at some point you were sort of really interested in the general high-level theme of biotech. I don't know if there were individual stocks or therapeutics or certain individual areas you had drilled that down into. Do you have any like specific ideas or plays? Here's the reason I'm asking you, Vecchio, is because I find myself in a way, there's these themes that I've been playing for maybe the last 9 months or more, and I'm trying to get myself exposure to sort of new ideas outside of these sort of core beliefs, this critical minerals, critical materials, natural resources type theme, with owning the barbell of high beta risk on the right tail, which is like the Bitcoins of the world. So I'm trying to get outside that theme, which is why the nature of where my question's coming from.
Is biotech high beta?
Biotech? Yeah.
Is it these days? Has it been for the past several months?
No, but I think, to me, high beta cuts both ways. But I think if you think the biotech world is sort of cheap or trading sideways in a world where it should be high beta, to me that can sometimes be a spread that it will normalize in time, or could normalize.
Yeah, no, before we get there, because I think one of the problems that these ETFs have is that a lot of the holdings, particularly some of the bigger holdings, have struggled for idiosyncratic reasons. So is biotech as an idea shot? No. But if you're holding IBB, if you're holding XLV because of UNH, for example, right, healthcare broadly speaking, it kind of sucks, right? Like, hasn't been a good run. In talking about those AI names, just though real quick, you mentioned about how you can't just pick a name out of the hat for water because so many of them are regional. It's that same way with talking about the utility companies. I, for one, will not touch a California utility company with a 10-foot pole, even if it has a compelling AI story, because I am just not going to risk the wildfire exposure at all. Right? So I'm more comfortable with, like, hey, are you a company that services data centers in Virginia and Pennsylvania? You're the company for me. I'm happy to play around with you and see what we can do there. If we get volatility spikes and the market holds up, look to sell some puts. If it's low and the market gives you a nice pattern, like I think Exelon had a few months back, buy some calls, put on a long call spread. But yeah, if you're trading any of the utilities, just understand it's a little bit of a different market. There's a lot of geographic regional risk in play. And you have to learn about that a little bit if you're going to play any individual company in particular, because they're not all created the same. P&G, Pacific, and all the California energy companies, right? A lot different than what you're going to see on the East Coast. Different risk profile entirely.
I think I hear what you're saying. To me, I would go like, Where's the opportunity where a large utility company could entrench itself in government corruption? I would say California would be at the top of my list. Where could you throw a bag of greenbacks at a governor and ensure that your business is protected and that it's at the harm of the overall citizen? That's California in my book. Let's talk crude oil, because this is a thing. I haven't touched this with a 10-foot pole. What do you do here? Are you going to short this down to 40, or is it now time to get long?
I mean, I've had a short put spread on for a few weeks, and I'm still comfortable holding it. I see that Iran and the U.S. and Israel, or the U.S. and Israel, are engaged in a game of good cop, bad cop with Iran. Trump's negotiating, and Iran is hearing that through the American press, by the way, the New York Post, Axios, that if they don't comply with Trump's negotiations around a revised Obama nuclear deal, because if you read the fine text, that's basically what it is, folks, then Israel will strike Iran's nuclear facilities. So you can negotiate with the good guy Trump, or you can deal with the bad guy Netanyahu. It's an interesting dynamic, right? And certainly, I think some of the messaging that you've seen out of Qatar in advance of Trump's trip to Saudi Arabia, where it was looking like that Trump and Netanyahu were on the outs and outs, I think it creates an important pretext for this, like, hey, I really just want this to end peacefully. I can't really contain this Netanyahu guy. If you and I don't get a deal together, I don't know what he's going to do. I can't hold him back. You see, we're not on good terms right now. So the best you can hope for is give me what I want. That way he doesn't overreact when he sees this thing go sideways. It's an interesting dynamic that's in play right now. We'll see if it works out. Obviously, oil spikes yesterday. It comes back in, or rather today, I suppose. Well, it's Wednesday for me still, but it's technically the Thursday futures market. But oil settles down a little bit weaker. When the world was at its weakest point, when we thought that global trade was ending as we knew it, oil was in the mid to...
We never thought that.
No. The collective market saw oil go from 72 down to 54 in a week. All right. Mm-hmm. Like, are we going back to that type of global environment? No. Asterisk, if we go back down to 54, it's probably going to take a little bit more time than it did last time we did in April, right? So I'm comfortable here near the 50% mark of the pre-Liberation Day high, post-Liberation Day low range. If I'm going to sell puts, if we go to the bottom side of the range, fine. If we get to the top side of the range, sell calls. If we're in the middle, directionally neutral. I'm not really compelled directionally in oil right now, but there is decent vol here. So there's a little bit more vol there than other products that I like. So it's worth sticking your neck in.
I think it's worth pointing out that the rig count since March has gone down from 593 to 576. So for all the drill baby drill stuff, if oil gets too low, you got a problem, and or growth expectations aren't where you need them.
I agree.
That whole narrative is going to have a little bit of a problem.
Victor, if I could just shamelessly point people to the archived episode of the April 9th episode of Futures Power Hour, which was called Killing Drill Baby Drill. We had a discussion about how oil prices were slipping below break-even rates for existing wells, for new wells, right?
How do you know this? How do you remember what you talked about on April 9th?
Because you just said drill baby drill, so then I went into my Google Slides and typed in drill baby drill, and it was there. The internet's pretty fast these days, Victor.
I thought you did that off the top of your head. And I was like, I don't even remember what I talked about on Monday, let alone on April 9th.
No, I find I hate saying to people as discussed earlier, as noted earlier, it's condescending, it's puffery. So at least I could say the reference this has been on our radar, and if you're interested in this kind of discussion, we've covered this content previously, and here's a specific reference to it.
Fair enough. My good friend, I enjoyed the conversation. Oh, wait, before you get out of here, silver. Nice little move, finally, in silver to the upside. You get a little bit of, it's not necessarily breaking out of this congestion area. We've been between 32 and 34 for almost 2 months now, a month and a half at least. And a nice little move to the upside in silver. If you were going to bet, and maybe you do have a bet on, but if you don't, if you were going to hypothetically bet, do you bet the breakout in silver above 34, or do you bet? Do you fade this and play it moving back down to the 32 end of the range? It's a 50-50, so it's more or less a sentiment question than anything.
I'm still long. I intend on rolling out my calls.
Long?
And long. I've been rolling long basically since last February. Just continue to roll up a little bit out of the money calls. Roll it up, roll it up, roll it up. High convexity trades, 3-to-1, 4-to-1. Risking $1 to make $4 every time. Sometimes it works out, other times it doesn't. If one of the trades works out, then I got 4 free trades in my pocket. Unfortunately, over the past year plus, it's been working out more than it hasn't. So the last trade is crap, but am I going to put it back on again? Yeah, because it's been working out. And as someone who's looking at a trend that seems to be breaking out to the upside, I will bet on the up. And betting on the metals the past year has been the most consistent thing that's made me money.
So I can find it.
I'm just not stepping away from a winning idea, which is just like buy slightly out of the money calls or call spreads in gold and silver. It's been working. So I'm not. Who am I to say? Right.
If we get a breakout here above 34, just know you and me, we're going to Sizzler, baby. Chris Vecchio, if the people want more from you, tell them where they can go.
Before I do that, today my wife and I, we had our 20 week anatomy check ultrasound, right?
Yeah.
And then afterwards we had to bring our daughter to her elementary school introduction testing they do to measure their reading and can they color in between the lines, whatever. And so as we're pulling out of the parking lot from the doctor's office, she goes, "Chris Vecchio, everyone, he's got to go to a school." And I'm like, "What? You're doing that too to me?" Just catching it from all sides. So thank you for that. Become part of the family lexicon.
Shout out to your wife. What a great callback. That is such a great callback.
I was like, oh, wait, you listen to the show. That's great. Yeah, all right. You can find me here on Tasty Live Monday through Friday, Futures Power Hour, 1 p.m. Eastern, Overtime with Radigan and Spivak, Monday through Thursday, 4 p.m. Eastern. Price of Truth on Wednesday, 6 p.m. Eastern. And then, of course, Tom and Tony for Let Me Explain, Tuesday mornings, 9:40 a.m. Eastern.
Chris Vecchio, everybody. Thank you very much, my friend. For all of you out there, before you get out of here, do us a favor. Hit the like button. Easiest way to support everything you see on the screen as well as the people behind the screen. Subscribe to the channel if you haven't already. If you want to send me an email, you can. victor.jones@tastylive.com. Or if you want to follow the rantings of a complete unhinged lunatic, you can follow me on Twitter @VictorJones. The Owen Jones is 0 because I like to be difficult. I'll see you back here tomorrow. Same time, same place, same great network, only on Tasty Live. Till then, peace.